There's a huge difference between what's going on Main Street and what's happening on Wall Street.
The general health of the economy, it's broken down.
We're expecting a prolonged period of elevated inflation.
We have an eye on the inflation data, but the one data point is not going to, I think, derail the path.
I don't think inflation is getting away from the Fed, which is why I think they should be focusing more on the growth side of the economy.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. Coming into Wednesday at all-time highs as Secretary Bessent is pushing for the Federal Reserve to recalibrate. The White House Fed pick Stephen Myron is facing a key vote on Capitol Hill, and a judge is blocking the president's effort to remove Fed Governor Lisa Kirk. That meeting just 1 week away.
Next week's not going to be boring. I think that we can say that fairly, that the Fed meeting on September 17th is going to be one of great interest. First of all, yes, Lisa Cook will be there. Will she vote? That's going to be something we can get into. Meanwhile, Stephen Myron also may be there, given that he probably will get ushered through Congress. So how much are we going to hear about 50 basis point rate cuts? How much are we going to get dissents across the board? Do we get some bigger numbers put out there? And how much does that affect market pricing of just what this Fed has in store?
The Treasury Secretary has been pretty clear about what he wants to see. His quote, "If the Fed is data dependent and the data is bad, makeup cuts are needed."
Well, he's basically said this to you and I, Jonathan, just a few weeks ago, saying given the revisions, and he wanted to wait to see what the latest report was going to say, and after the latest downward revision of basically BLS overstating the jobs, almost nearly 1 million jobs in the United States of America, Treasury Secretary easing towards kind of urging the Fed to cut by 50 basis points. That potentially could be on the table. Definitely already 25 basis point the market has baked in.
He's asking the right question. If we knew at the time that payrolls were 75K less every single month over that year, where would rates be this morning? Isn't that a question the Fed's got to ask themselves at this meeting?
And it's the reason why they cut by 50 basis points last year around the same time. So by the same logic, couldn't you make the same assumption now that actually we may have seen a couple of negative payrolls prints if you take the adjustment into all of the models and take a look at June and July and August, and you start wondering, okay, is the labor market at the behest of Fed policy? And is there something else driving earnings and driving corporate success other than what's hinged to the labor market? This divide I have to keep coming back to, and can Fed rate cuts really support a labor market that has a lot of very idiosyncratic aspects to it?
You say you're data dependent, but in real time the data isn't that dependable, and that's a big problem. Later on this morning, more data. PPI, 8:30 Eastern Time tomorrow morning. CPI this morning. Equity futures just about positive on the S&P 500. We have got a busy 60 minutes coming up. Tchir of Academy Securities as President Donald Trump floats new tariffs to pressure Russia. We'll catch up with Haines of Pangaea as a federal judge blocks the president from firing Fed Governor Lisa Kirk, and Daco of EY on a massive labor market markdown. We begin this hour with our top story. Escalation risk in Europe. Poland striking down Russian drones. With the latest, Bloomberg's Ollie Crook joins us for more. Ollie, what do we know about how deep this went into Polish territory, and also whether this was deliberate or an accident?
So those are the fundamental questions, John. What we know is that there are more than 10 drones that crossed into Polish airspace, and a number of them were shot down by the Russian military. It closed down a huge amount of Polish airspace, including the international flights and the international airport outside of Warsaw. This is not, John, the first time we've ever had shrapnel and other sort of missiles, projectiles reach into Poland. You'll remember in the early days of the war, there was a missile that overshot Ukraine and landed in Poland, and that provoked a great deal of concern and anxiety among Europeans and really globally about whether that sort of event is the kind of thing that triggers Article 5. The reason, John, this is significant is this is the first time a NATO country has shot down anything from Russia over its own skies since the beginning of the war, and it has caused the Prime Minister, Donald Tusk, to invoke Article 4, to call for NATO to invoke Article 4, which is not Article 5, but reads as follows: the parties will consult together whether, in the opinion of any of them, the territorial integrity, political independence, or security of any of the parties is is threatened. And we should say it's significant because it's only ever happened 7 times before since 1949. And that is the question before the Europeans today. How big a deal to make of this? Is this a deliberate effort by the Russians to encourage, to test the distance of NATO, or is it just indifference from Vladimir Putin, basically not shaken by the possible threat of Article 5? Either way, it sends the same signal to the Europeans and, in fact, to Donald Trump, who's trying to bring Putin to the negotiating table, that Putin is not really terribly afraid of NATO and that he's feeling emboldened and not really moving his way towards a ceasefire conversation.
So, Ollie, this is how the president wants to address things. He wants the Europeans to go hard and go after Russia's biggest partners, India and China. He wants the Europeans to ramp up tariffs. And he's essentially telling them, if you do this, we will too. How's the EU and European partners responded to this?
Yeah, Jonathan, this is a really sort of interesting dilemma for the Europeans to find themselves in. So this was after a call in D.C. between EU officials and U.S. officials. Trump gets on the horn. He says, listen, we're willing to go 100% tariffs on China, 100% on India for buying Russian crude to stifle their ability to fund the war in Ukraine, but only if the Europeans go first. The Europeans need to pose themselves a lot of difficult questions. I think what the Europeans would like is for the United States to go at this alone and not really have to get involved, but they need to ask themselves, are they really willing to torch their relationships with China, with India, who they're trying to vaguely retain in this sort of Western orbit of influence, just because Donald Trump has put this sort of on the table? Maybe they would if they could rely on Donald Trump, but at the end of the day, they have very little faith that there's going to be necessarily follow through from the United States. And are they going to charge headfirst into a tariff war with China and India, only to be sort of stood up potentially, or whenever the sort of interest of the United States shifts? But listen, it's a very interesting dilemma for the Europeans to be put in. They need to find another way to put pressure on Russia in order to end this war. Maybe this begins a conversation, though I do not see them, putting in 100% tariffs on China or India. That's just not how the EU works.
Ollie, appreciate the latest. Ollie, live with the latest from Berlin in Germany. Annmarie, the Treasury Secretary, sat around this table only a few weeks ago and made this exact point.
He said that he was at the G7 meeting. He brought up the fact that maybe Europe needs to start getting on board, tightening the screws when it comes to China, India, secondary tariffs or sanctions. He said at that point, everyone decided to look at what kind of shoes they were wearing, a.k.a. everyone got silent because the Europeans don't want to do it.
Let's see what their response is in the coming days. For The View on Wall Street, Peter Tchir of Academy Securities joins us around the table. Pete, good morning.
Good morning.
It's the great European contradiction. They want the warm blanket of American security and they want to maintain an economic partnership with a country like China. Is that becoming unsustainable now?
I think even let's take a step back. Let's revisit the sanctions that have always kind of been loosely enforced, not really enforced. Europe has continued to buy Russian, energy products this entire time. So as a starting point, I think, how about we really crack down on the sanctions in place, make sure that's happening, and then maybe push on the secondary tariffs. I think that would be a good outcome from this, is a real commitment to actually enforce the sanctions on the books and move that direction. I think you can put pressure on Russia that way. And secondary tariffs, I think, are going to be harder for countries to swallow than actually enforcing the sanctions agreed to.
When you say enforce the sanctions, you mean the United States or the European Union?
Primarily the European Union, right? They have continued to buy Russian products. They've, looked, I think, the other way when they buy it from Kazakhstan, knowing that it was probably shipped from Russia into Kazakhstan. So I think really enforcing, isolating Russia as much as possible, where their only counterparties really are China and India, would be a good first step. Can China and India support them? And if there's a talk of secondary tariffs, maybe that slows down China and India's interest in dealing with Russia, puts the squeeze on them. Maybe Xi calls Putin. Because I think, our view has been, unless we really do something, the stick to Putin, he's not coming to the table. He's fine with the war. He thinks they're winning. And clearly with the, incursion in Poland, he's a little bit, carefree and is going to push the envelope.
Do you think it was deliberate, what we saw overnight?
It's hard to say, but I think it's definitely an indication that he is nowhere close to coming to the table and doing some sort of ceasefire. He believes he's winning. Every step he is taking is to push the West and set up better, boundary lines in Ukraine, so if and when there is a deal, he can claim more land.
It wasn't just this. We also saw overnight Israel attacking a site in Doha to attack Hamas leaders. This comes at the time as we were getting downward revisions to jobs. It felt like a dumpster fire. Stocks reached record highs. Can you explain that?
I think stocks have been very conditioned to rate cuts equals higher stocks. So I think that's a little bit of the mode we're in. I have to admit, I don't follow Oracle as a company, but their earnings, their projection was really good. So you're seeing that. So I think so long as we continue to spend on the AI, and I do think we are seeing this kind of what we've been calling, national production for national security, whether it's investments in Intel, MP, I think you're going to see more and more efforts by this administration to, produce the things that we need for national security. And I think that's a positive.
Okay, there are positive stories here, but are we conditioned to just ignore geopolitics because it always seems to be overblown at first headline, then calm down? Are we just conditioned to shrug it off and say, if I can't predict it, I'm not going to price it?
Yeah, I think that's a big part of it. So I think this will kind of, and again, we've had enough success, right? Where, we've pushed back on people, they've, pulled back. We've, Iran's been very quiet in the last few weeks. So I think you can see some of that. I'm a little bit worried geopolitically. I do think we are going to try and enforce these sanctions. There will be more chatter about secondary tariffs. I think the economy is slowing. I think when we look at, I would say garbage in, garbage out. My background was computer science, right? Garbage in, garbage out. So I don't think we spend enough time looking at the data, right? We take the data and put it into models. I think the Fed's been doing that. Like, whoa. Let's take a look at this data. We've been complaining about the birth-death model, saying that, right, what this does is take EIN applications, so people looking for new businesses. And traditionally that meant, you were starting a business, you hired a few people. I think now in the gig economy, what it is someone gets worried about their job, says, well, maybe I'll drive Uber on the side or Lyft on the side. They go ahead and get themselves an EIN. So it's not a real job. It's not creating this. The Fed should know this. I think that, or the BLS maybe should know this. That's why we've had that revision. And what really scares me, if you look from April to this year, we've produced 260,000 jobs in non-farm payrolls. We've had 960,000 birth-death model jobs, right? What if those are largely fake? We could be losing jobs in this economy, which is kind of my assessment of where we are. We should be moving aggressively, and I think the Fed and Treasury should combine to do something to control the long end so we don't get a repeat of last September.
Okay, there's a ton to unpack there.
Sorry.
Okay. Let's start with rates, and then we'll get to the balance sheet, okay? On interest rates. I don't know what's going to happen in the next 24 hours with PPI and CPI, but let's say it's in line. Is 50 basis points on the table?
Yes, I think so. And let's talk about garbage in, garbage out one more time. We still use owner's equivalent rent to track, shelter, one of the biggest components of CPI. There's a huge lag effect on that. First off, go ahead and I dare you to read what OER is. It's painfully confusing. It doesn't reflect reality. And in this day and age, right, the Cleveland Fed has a real-time rent estimate. Zillow has real-time rents. Why aren't we actually tracking that, which is much lower than what the OER is telling us? So I think CPI is overstated. So again, we're kind of garbage in, garbage out, and we've been overstating jobs, making the Fed reluctant, and we've been overstating inflation, making the Fed reluctant. I think both are going to be revised down significantly. If you look at reality, they should have gone 25 already. I think 50 should be on the table.
So that's interest rate policy. Now, I want to give you some credit. You are one of the very few that is really focusing on what could happen with the yield curve, looking out 12 months when we get a brand new Fed. What are you telling clients about what they should be focused on?
I think that people should be putting flatteners on. I think a lot of people expect kind of a repeat of last year where we lose control over the long end when there were the rate cuts. I think Besson and the Treasury are already doing bond repurchases, so I think they're doing some of this. I think there's a lot of room on the Fed balance sheet to do an Operation Twist. So I know Besson's spoken to you. He does not like QE, but Operation Twist is technically not QE, right? It's balance sheet neutral. It does take duration out of the market. So I think that would be something that you could do. Extend there, maybe even switch some of it out of T-bills or short-dated notes into mortgages, right? Because that's been a huge focus of this administration. So I think there are things that Fed could do in conjunction with Treasury that support that long end of the yield curve.
We've been talking about it on this program repeatedly. Listen to what the Treasury Secretary and the administration are telling you. What do they want? It's not just lower rates. What they want, very specifically, is lower borrowing cost and lower mortgage rates. To achieve that, you need more than just an interest rate tool, potentially.
This is the reason why it's so interesting to see the composition of the Fed and just how much the president can get his fingerprints on some of the Fed officials, because they might be more willing participants in Operation Twist or what have you to be creative to get those long end rates down.
Pete, this was very cool. Thank you, sir. Peter Tchir there of Academy Securities. Yields down at the front end this morning, lower by a single basis point, the 2-year 3.54. With an update on stories elsewhere this morning with your Bloomberg Brief, let's cross over to Vonnie Quinn. Hey, Vonnie.
Hey, John. Poland shot down drones that crossed into its territory during a Russian airstrike on Ukraine. The Polish military calling it a, quote, act of aggression, and said the drones posed a threat to the safety of our citizens. It's the first time Poland has shot down military aircraft that have strayed into its airspace since the start of Russia's war on Ukraine. President Donald Trump told European officials he's willing to impose new tariffs on India and China to push President Putin to negotiate with Ukraine, but only if EU nations do so as well. Other potential measures discussed include further sanctions on Russia's shadow fleet of oil tankers and restrictions on its banks and major oil companies. Oracle shares are surging in the pre-market after the company gave an aggressive outlook for its cloud business. Oracle's cloud infrastructure revenue increased 55% to $3.3 billion, with the company signing 4 multi-billion-dollar contracts with 3 different customers in the quarter. And that's your Bloomberg Brief. John?
Vonnie, thank you. Appreciate it. More from Vonnie in about 30 minutes' time. Up next on the programme, Governor Cook stays on the board.
Dr. Cook hasn't said she didn't do it. And as with so many of President Trump's policies, we've seen these activist courts get in the way. Eventually, if this has to go on an expedited basis to the Supreme Court, President Trump is winning.
That conversation up next with Terry Haines of Pangaea, live from New York City this morning. Good morning. Two-day winning streak on the S&P 500, all-time highs coming into Wednesday. Equity futures add some weight to the rally, up by 0.2% on the S&P. On the Nasdaq 100, up by 0.14. Under surveillance this morning, Governor Cook stays on the board.
Dr. Cook hasn't said she didn't do it. What we've seen is that she's saying, she and her attorney have gone to court and said that President Trump doesn't have the right to fire her for cause. And as with so many of President Trump's policies, we've seen these activist courts get in the way. Eventually, if this has to go on an expedited basis to the Supreme Court, President Trump is winning.
So here's the latest this morning. A district judge siding with Fed Governor Lisa Cook, at least for now, blocking President Trump's attempted firing. Bloomberg's Tyler Kendall joins us now with the latest. Tyler, good morning. Reaction from the White House literally just seconds ago.
Right, moments ago, John, good morning. And the White House is really doubling down on its argument that they have sufficient cause to fire Lisa Cook after this decision by this judge that will allow Cook to retain her seat while the broader questioning of her firing does play out in court. And I want to read you some of what we just got from the White House, saying that this ruling will not be the last say on the matter, and the Trump administration will continue to restore accountability and confidence in the Fed, alluding to the fact that they are going to swiftly appeal this decision that came down the other day. Now, the judge said that Cook is highly likely to succeed on her arguments that President Trump did not have sufficient cause to fire her. And it was interesting to read in her decision. She highlighted the fact that these allegations of mortgage fraud had to do with Cook's private conduct, nothing to do with her time as a Federal Reserve governor. And Cook's lawyers have previously suggested that if there were any discrepancies on her mortgage applications, that they were unintentional and likely due to clerical error. Now, as we wait for the Justice Department to officially appeal this ruling, we do know that DOJ lawyers have previously argued that it is within the president's right to determine what is sufficient cause to remove an official. Importantly, also, I wanted to highlight that this judge said that Cook's due process rights were likely violated, but the administration time and time again has said that they gave Cook sufficient time to respond to the allegation, pointing to the 5 days between FHFA Director Bill Pulte posting the allegations on social media and then President Trump posting her termination on social media as well. John, this looks like it's going to head to the Supreme Court, and while the High Court has actually weakened protections for officials at independent agencies in recent rulings, they did signal back in May that the Fed could be a special case.
Tyler Kendall in Washington. Tyler, thank you. Got the full statement right in front of me. Allow me to share it with you. The president lawfully removed Lisa Cook for cause due to credible allegations of mortgage fraud from a highly sensitive position overseeing financial institutions on the Federal Reserve Board of Governors. The statement goes on to read, this ruling will not be the last say on the matter, and the Trump administration will continue to work to restore accountability and confidence in the Federal Reserve.
So basically what you see here is that they're already preparing for their lawyers to once again appeal, and this is likely headed to the Supreme Court. Tyler makes a very good point. We heard from the Supreme Court just months ago that the Fed is considered a quasi-independent private entity, this independence. At the same time, we have seen the Supreme Court be a little bit more lenient to the Trump administration. And I think what comes down to here is what matters for cause. Will the Supreme Court agree with this judge when it comes to for cause for the Federal Reserve Act? Does it mean that something that has to happen while Lisa Cook was on the job?
Terry Haines standing by. Terry Haines of Pangaea Policy. Terry, welcome to the show and good morning to you, sir. The Treasury Secretary says ultimately this will go to the Supreme Court. He suggested ultimately the president will win. Do you see it that way too?
Good morning, John. And, well, I agree with Secretary Bessent on lots of things, and I'm one of your chorus who always urges people to pay attention to what he says because he's giving markets clues on lots of things. I think this ultimately does go to the Supreme Court. There's an appeals court level in between, so this might take a while. And there's a preliminary injunction now against the president removing Ms. Cook. So I don't think that's going to happen anytime soon. So that's number one. Number two, I applaud the secretary's loyalty to the boss, but at the same time, I don't think he wins. And this is a very, very simple case. It's even, with respect to my friend Annmarie, it's even simpler than most people think because the Federal Reserve is a creature of Congress. It's the Adam's rib it comes from is the Congress that exercises congressional authority. Ultimately, with the exception of a for-cause clause, the president has no ability to deal with the governors. That's all Congress. So I think the president should get ready for a little disappointment here.
Well, Terry, what happens, though, if Lisa Cook, given that we have this DOJ investigation opened, what if she is convicted of mortgage fraud?
Well, then the facts change. And, the easiest way to look at this case is allegations are not cause. Full stop. And, and that's always true. And that's going to be true here. And I've always said two things. One is that. The other thing is that the facts are going to determine whether or not for cause is sufficient. And if she actually committed criminal mortgage fraud, yeah, he's within his rights to remove her. Sure. If not. The punishment's got to fit the crime here. One of the things I said to markets on Sunday was, there's nobody that's actually defending Fed independence. Forget Trump. Cook herself isn't by politicizing this case. The Congress isn't by not taking up its responsibilities. Even the Fed punditry around it, pushes the thing for its own purposes rather than defending Fed independence. Somebody ought to start defending Fed independence. That probably starts with the Congress, as former banking chairs Graham and Hensarling pointed out last week in the Wall Street Journal.
So who do you think needs to step up and do this in Congress?
Well, the relevant committees in Congress, Senate Banking Committee, certainly. But, the Fed itself isn't defending its own independence. The Fed in the past has run independent investigations of its own governors for conduct. The Fed has an inspector general. The Fed has more than enough ability to deal with this itself. Bessent, by the way, pointed that out a couple of weeks ago. The Fed's still not doing anything. I understand they might think it's a poison chalice they don't want. But, the institutional integrity starts with the institution itself. So, my 2 cents is they ought to take it up.
A lot of people are throwing around this word independence and integrity and the idea of maintaining some level of autonomy in the central bank. What does that look like, since we've seen that defined about 15 different ways?
Well, the way it is defined is that in the Federal Reserve Act is that as I say, the Fed isn't an independent fourth branch of government with its own authority. The Fed's power comes solely from Congress. That's it. Under the Federal Reserve Act, Congress gives the Fed kind of the granular authority to make its individual monetary policy decisions free of interference from Congress. Otherwise, it's got the same oversight. The Congress has the same oversight over the Fed as it has over any other agency, including the Federal Trade Commission, the FCC, the SEC, anything else. So markets have talked themselves into this grand independence, a la the European Central Bank. That's never existed. But what's existed all along is the commitment to letting the Fed do its job independently with respect to monetary policy. Everybody ought to want that to continue, but the way to do that is to hone in on what that is and how to preserve it.
Hey, Terry, appreciate your time as always, sir. Terry Haines there of Pangaea Policy. When you've got something on the calendar that you're super anxious about, can you imagine Chairman Powell's feelings about next week's meeting? He must be absolutely dreading what's about to take place next week.
He's just stockpiling Xanax. I have no idea, but I'm just suggesting, maybe that's one way of dealing with it.
Talk about awkward.
I mean, come on. I wonder what the range of potential feelings are going to be on that committee.
That decision a week away. Up next on the program, the former senior U.S. intelligence official Norman Roule as Israel targets Hamas in Doha. Two-day winning streak on the S&P 500, five-day run on the Nasdaq 100, all-time highs on the S&P. Going into more economic data later this morning. That's the equity setup this morning. Futures positive on the S&P, on the Nasdaq, in the bond market, 2-year, 10-year and 30-year. The 2-year bond yield rising yesterday after dropping for 4 consecutive days. We're back lower again this morning by a basis point, 354.79, following some monster revisions on payrolls and heading into some key inflation data.
Does PPI or CPI even make the needle turn in any which way, or are people focused purely on the idea that there was a downside revision that was the greatest number in data going back to 2000 and the greatest on a percentile basis going back to 2009? At this point, the market is betting not really. It would take a pretty hot print, which is why a lot of people are wondering, does it even matter?
Payroll cementing the dovish bias of the Federal Reserve for next week's meeting. That's some of the price action in the bond market. Let's get you some morning movers with Yahara Anand, who has more. Hey, Yahara.
Hi, John. It's the big story this morning. Oracle shares up 30% in the pre-market after it gave a very bullish outlook. The company's booked revenue is up 359% from the same time last year, climbing to $455 billion in the latest quarter. That's thanks to massive cloud deals with the likes of OpenAI, TikTok, and NVIDIA. And the growth not stopping there, with the CEO saying that the cloud infrastructure unit will pull in $18 billion this year. And that number is expected to explode to $144 billion by the end of this decade, underscoring the huge demand for computing power. And that is helping to lift other AI infrastructure plays as well. We are seeing shares of NVIDIA, which, as I said, is a major Oracle customer, up 2%, while Karoui, which provides similar cloud services, is up 7%. And we make a hard pivot to the weight loss market, with Novo Nordisk shares up 2% in the pre-market here in the U.S. because the company is slimming down. The drug maker announced that it will slash 9,000 jobs globally, which will help it save $1.3 billion by 2026, money that it plans to spend on research to develop new drugs and on sales, because it has been falling behind Eli Lilly in this booming weight loss market, and it cut its profit forecast for the third time this year. So investors hoping that this will help turn things around under a new CEO who just took the helm last month. John?
Yahara, thanks for the update. Appreciate it. More from Yahara in the next hour. On our radar this morning, some of our top stories. President Donald Trump looking to impose tariffs of up to 100% on India and China if EU members join. Sources telling us here at Bloomberg that Trump made the offer to EU leaders in order to ramp up the pressure on Russia. Elsewhere, Fed Governor Lisa Cook staying on the job for now. A federal judge blocking President Donald Trump's attempt at removing Cook ahead of next week's FOMC meeting. The White House saying this morning this ruling will not be the last say on the matter. And finally, JP Morgan, Barclays, Fifth Third Bank, facing the possibility of hundreds of millions of dollars in combined losses. People familiar with the matter telling us here at Bloomberg the changes are tied to subprime auto lender Tricolor.
This is actually an incredibly interesting story on a number of fronts. On one hand, yes, you could say the losses, hundreds of millions of dollars, not going to really move the needle for the likes of JP Morgan. But when there's one cockroach in the kitchen, how many more are there? This was a company that focused on lending auto loans in particular to poor individuals in the United States, a lot of immigrants. And some of the lenders are looking into allegations that potentially some of those auto loans, the actual receivables, were double pledged to other assets, right? There was this huge layoff from Tricolor staff over the past couple of weeks. And here's my question, right? How much does this indicate the fraying between the economy, which isn't doing so great, and corporate America, which has been going gangbusters, even with layoffs and all these other things? There's so many stories wrapped up in this. It's a mystery to see this coming out at a time supposedly of such strength in corporate America.
Potentially a serious story. I'm just impressed that both of us got through this without saying tricolor.
Well, I really struggled there for a second. And
Did you feel that too?
I was waiting for it.
You saw this, right?
You were laughing, so I was trying to. Tricolor.
Tricolor.
Yeah, it's like, well, it's, okay, let's move on.
Tricolor.
Yeah,
okay.
You did a great job.
Going to come back to that story a little bit later this morning, a serious one. Let's turn to another serious one in geopolitics in the Middle East. Israel conducting an unprecedented strike in Qatar, targeting Hamas senior leadership. The president showing a rare break from supporting Israel's actions.
I was very unhappy about it, very unhappy about every aspect, and we got to get the hostages back. But I was very unhappy about the way that went down.
Joining us now from the region is Bloomberg's Jemana Basechi. Jemana, welcome to the programme. Let's just get into this. How is the region responded to this?
Shock and anger. Condemnation came through straight away, both from Qataris who were irate, I would say. If you listen to the Qatari Prime Minister Sheikh Mohammed's press conference yesterday, visibly angry, likening the attack on Doha to state terror. He said it is a blatant violation of international laws and norms and also a violation of moral standards, referring to the fact that there is an unwritten rule of diplomacy and that you don't attack chief negotiators and you certainly don't attack the country that is hosting those mediation talks. Now, what should be noted here is that despite the attack, the chief political brass that Israel had been targeting survived the attempt. Khalil Hayya was the person that they were mostly looking to hit in this attack, and he actually survived. And this morning, the Israel Defense Minister, Israel Katz, said that they will continue to go after their enemies. And why is this relevant? Because if you expect, or if the expectation is that Qatar will continue mediating, they also need to have guarantees that an attack like this will not happen again. And so later in the evening, a call was reportedly a call took place between President Trump and the Emir of Qatar, where President Trump urged Qatar to continue along with their diplomatic efforts. But in exchange, Qatar have said quite explicitly that they need to have a guarantee that incursions like this will not happen again. So the bar is just so much higher now in terms of a diplomatic breakthrough. And of course, the backdrop to all of this is the U.S. had put forward another ceasefire proposal. Yesterday, the Israeli Prime Minister said that they're willing to sign up to the terms of that proposal, but it's up to Hamas now to accept some of the terms that are being put down. No answer, obviously, from Hamas. And at this point, it is unclear whether Qatar will continue with the same momentum and with the same drive as they did before, given the uncertainty around those security guarantees and the assurances that an attack like this won't happen again.
Jumana, great reporting, as always. Jumana Basechi, leading some of our coverage out of the region, joining us from Dubai this morning. The former senior US intelligence official Norman Roule writing this: in the near term, the attack will put Hamas leadership in a state of crisis as it seeks to survive, maintain command and control, and develop a strategy to sustain the organisation. Norm joins us now for more. Norm, welcome to the programme, sir. As we know, Israel is at war with Hamas. And as we also know, Hamas isn't just in Gaza, it's elsewhere. Do you consider this a one-off or a new front?
This is neither a one-off nor a new front. Since October 7th, the Israeli military has adopted a strategy where they're using their excellent intelligence, their superb military technology to go after high-value adversary targets throughout the region, to eliminate those targets before the adversaries can develop plans to repeat an October 7th-like event. We've seen the Israeli military operate in Lebanon, Syria, Yemen, Iran, but Qatar is different. Qatar is not an adversary state. It is a member of the Gulf Cooperation Council. In Israel's entire history, it has never conducted military operations against the Gulf Cooperation Council. Israel is also a partner of the United States, a major non-NATO ally. And indeed, Israel has conducted diplomatic engagement in Qatar with Hamas and with the Qatari government. So the Israeli action in Qatar is extraordinary by many measures.
There's also a massive U.S. base there in Doha, Norm. Is this another red line that turned pink, where we just are struggling to now find where the lines in the sands are?
We're in a region where many red lines have turned pink. For many years, the Iranians turned many red lines pink as they broke many diplomatic norms. But now the U.S. has attacked Iran. The Israelis have attacked Iran. Now the Israelis are attacking different places. We're watching a region where issues that everyone believed the rules of the game were understood are no longer understood. And I think this has unsettled many of the region's leaders who have looked for a stable future as they develop economic plans and social plans, as they're trying to stabilize what has been a difficult region for many years, has made them very concerned. And for this reason, Israel is seen by some as a disruptive actor. Now, in Israel's defense, they have made it clear Hamas was responsible for October 7th. Its leaders are dead men walking, and they're going to eradicate the organization. They have not veered from that posture, and they have not gone after other actors, and they're not going after their neighbors. They're just going after individuals we consider to be terrorists. Final point, Hamas is considered to be a terrorist organization by many of the states in the region, to include by many of the states of the Gulf Cooperation Council.
Yeah, you said something very important there, Norm, that increasingly a lot of people in the region, a lot of leaders are viewing Israel as the disruptor or the destabilizer, in some ways even more than Iran. How much does that take off the table, any idea of normalization?
Well, I think normalization is not on the table in the near term. But we also want to be clear as well. If you are a believer in the Indian Middle East corridor to Europe, it's a simple matter of geography. The idea of communications, energy, or other lines going to Europe, you need the geography of the Levant or Israel. Now, when that happens is a different question. And how that happens is a different question. But sooner or later, engagement with Israel is going to be a reality. But in the near term, that's not going to be the case. At the same time, Israel and Iran are in very different categories. Iran is creating militias that kill civilians routinely. Iran has shut down the Red Sea with the Houthis. Iran has proliferated ballistic missiles to terrorist organizations. Israel does none of this. Israel and Iran are in very separate categories.
This also, though, ties the hands a bit of the United States, which is trying to walk this very fine line of maintaining relationships with Qatar and others in the Gulf region, while also being somewhat supportive of Israel. What do you make of the recent break with President Trump in response to Israel and a sort of fraying of the relationship, it seems, at least on the face, between President Trump and Bibi Netanyahu?
Well, we have seen some evidence that the United States will go in a different direction from Israel in other areas in the past. For example, the United States has spoken with Hamas directly at times, and that was not always something that Israel accepted. The United States held talks with Iran longer than Israel may have seen appropriate. Likewise, when the president visited the Middle East in May, he did not visit Israel, which some people saw as unusual. The United States has an independent policy in the Middle East from Israel. That's that. But at the same time, there is no question in my mind the president of the United States is committed to the defense of Israel and standing with the Israeli people when necessary if they're under threat by Iran. But he is clearly not supportive of this action because it disrupts many of the efforts he had underway to work to free hostages.
Norm, thanks for making time for us this morning. We appreciate it. The former senior US intelligence official, Norman Roule. We've had some brief comments from the president in reaction to this story. A full statement coming a little bit later.
Yeah, he was outside yesterday briefing reporters before he went into dinner, and he said he's never surprised, really, by anything that happens in the Middle East. He said he'll be giving a full statement today, but he said this: I was very unhappy about it. So obviously, this White House is seemingly pretty annoyed with how Israel conducted themselves in the region.
We'll look for that statement a little bit later this morning and later on today. Equity futures on the S&P 500. If you are just joining us, positive here by 0.25%. Later this morning, the main event, 8:30 Eastern Time, PPI data. Tomorrow morning, we'll get CPI. Let's get you an update on stories elsewhere with your Bloomberg Brief. Let's cross over to Vonnie Quinn. Hey, Vonnie.
Hey, John. Thank you. The Supreme Court has fast-tracked a challenge to President Donald Trump's tariffs. The court agreed to hear cases brought by businesses hurt by the levies in the first week of November. The tariffs remain in place for now, but a decision striking down the tariffs could cut the U.S. refund amount to tens of billions of dollars, which it will have to pay back. Apple rolled out its next-generation iPhones at an event yesterday. The iPhone 17 lineup includes a new slimmed-down model called the Air, a name it already uses for its sleekest iPads and Mac computers. All 4 new iPhone 17 models will feature better cameras and longer-lasting batteries than last year's lineup and will be available in stores September 19th. South Korea chartered a plane to bring home hundreds of workers being detained in a U.S. immigration crackdown in Georgia. The plane was set to take off today, but South Korea's foreign ministry said the departure has been delayed due to U.S. circumstances. Officials are in talks with their American counterparts to return the detainees as soon as possible. And that is your Bloomberg Brief. John.
Vonnie, thank you. Appreciate it. More from Vonnie in about 30 minutes from now. Up next on the programme, a massive jobs revision.
This was one of the biggest revisions in absolute terms in decades. And the benchmark year, March 2024 to 2025, shows that the job growth was vastly weaker during the Biden administration than ever previously reported.
What does it mean for policy from here? Greg Daco of EY joins us next, live from New York City. You're watching Bloomberg TV. We're getting a double dose of inflation data in the next 24 hours at 8:30 Eastern Time, PPI. Then on to tomorrow, CPI. Next week, a week today, a Federal Reserve decision just around the corner. Coming into that, your scores look like this morning. Equity futures positive by 1/3% on the S&P, up by 0.2 on the Nasdaq 100. Under surveillance this morning, a massive jobs revision.
This was one of the biggest revisions in absolute terms in decades. In the benchmark year, March 2024 to 2025, shows that the job growth was vastly weaker during the Biden administration than ever previously reported. Between this revision and last year's, job growth was actually overstated by approximately 2 million jobs.
So here's the latest this morning. The White House reiterating criticism of the BLS on the heels of disappointing benchmark payrolls revisions. The Treasury Secretary, Scott Bessent, calling on the Fed to recalibrate its stance, writing this: President Trump inherited a far worse economy than reported, and he's right to say the Fed is choking off growth with high rates. Joining us now to discuss is Greg Daco, the chief economist at EY. Greg, good morning to you, sir.
Good morning.
Let's talk about these revisions. Do they matter going forward for policy from here?
I don't think they matter that much going forward, but they do reflect an economy that was softer than previously anticipated. So what matters, I think, going forward is the momentum that we carry into the rest of the year and into 2026 when it comes to the labor market. And there, we're seeing softness. The latest jobs report indicates that over the last 3 months, we've only been adding about 30,000 jobs a month. And we have a bunch of other economic indicators on the labor market front that are also pointing towards that softness. The flow of labor market activity when it comes to hiring is at a 10-year low. You're seeing a creep up in the number of people that are filing for unemployment benefits. You're seeing long-term unemployment rate measures that are at the highest in the post-pandemic era. So you are seeing more evidence of a softening in labor market conditions. And the very reason why this matters is because this is weighing on income growth momentum and in turn forcing consumers to make difficult decisions when it comes to spending activity. And that is where you're going to see the slowdown coming out of consumer spending activity.
If this Federal Reserve was aware at the time of just how much weaker this labour market was, would rates be lower this morning than they are now?
I think the Fed would have been on an easier trajectory when it comes to monetary policy. If you look back over the last few months, we've had a few policymakers led by Governor Waller arguing that there was room for the Fed to neutralize monetary policy. We're not talking about vast rate cuts to bring rates down close to zero. We're talking about a move that would bring the Fed funds rate from a slightly restrictive stance towards a more neutral stance over the course of the next few months. And now we have greater evidence of this labor market softness. Again, it's not a cliff, but we are seeing increasing evidence of a visible softening in labor market conditions, and that should be a rationale for the Fed to be neutralizing monetary policy with gradual rate cuts, especially in an environment where underlying inflationary forces were moving towards 2%. We don't have the risk of second round effects from inflation via the wage growth channel in an environment where the labor market is softening.
How much power does the Fed have to juice the labor market right now by cutting rates?
Well, I think the Fed has the power to buffer the shocks that we're seeing right now. We're seeing a number of supply side shocks that are constraining the economy. The trade and tariff shocks, the immigration shocks, the higher pressure on goods price inflation, and the Fed has essentially the ability to essentially limit the pressure from higher interest rates on the economy. Now, one important caveat here is that what matters perhaps more for the economy is long-term rates. So the Fed does not necessarily have that much ability to control long-term rates, and so the cost of credit may actually remain higher if there are a few factors that keep these long-term rates high. One, the lack of Fed credibility and potential political influence on the Fed. Two, the risk that we see ongoing policy uncertainty, keeping those long rates higher. And three, the risk that there is this anticipation of higher inflation for longer that may also pressure long-term rates.
The reason why I ask, Oracle yesterday came out. They performed amazingly. They said that they have this 77% expected increase in their cloud computing services in particular. Stocks surging, $200 billion of market cap gain. When you look at the details, they're going to spend more money and they're going to cut staff in order to do it. Yep. And they've continued to cut staff. And you've seen this around the board with a lot of these big tech players that have been fueling a lot of the gains in investment in the economy, reducing staff to do it. Yep. Doesn't this suggest something bigger than what the Fed can address by cutting interest rates?
I mean, there's only so much the Fed can do in the face of supply shocks. So that's the first thing we have to realize. We're in an economy where we're no longer driven only by demand shocks. We're increasingly driven by supply shocks. And the very type of developments that you're talking to in terms of a potential technological revolution is another sign of this supply shock. It's working the other way than tariffs or immigration shocks because it's actually increasing supply, but it's doing so in a way that is revolutionizing the way we think about labor market activity. And so that's another factor that may limit labor supply and mean that we need less labor demand in this environment and therefore not as much pressure upward on the unemployment rate. So I'm very much in line with that view that we're seeing an economy that is currently being exposed to a number of supply shocks that are distorting the traditional measures that we typically use to measure how healthy an economy is. Notwithstanding that, I do still think that we're seeing a slowdown in labor market demand that is weighing on income and in turn will force consumers to make those difficult decisions to start pulling back in terms of consumer spending activity. And businesses are also feeling the pinch. They're in this uncomfortable environment where the cost of goods, the cost of services is increasing, and their customers have less ability to spend in a higher cost environment. So they're seeing their margins being squeezed. I think we'll see some of that actually reflected in the PPI data, where the markups that were a key factor driving PPI increases last month are actually going to be under pressure over the course of the next few months.
But didn't Chairman Powell tell us all to look through it? It's not really going to matter just yet in terms of the tariff impact on inflation?
Well, I think it's likely to be a one-time shock because of this softness in the labor market. We're not necessarily going to see employees bargaining for greater wages, and employers are constrained by these higher input costs, so they're likely to put downward pressure on wage growth. And so I would anticipate that over the course of the next few months, we're going to see more moderate wage growth pressures, which means that there is less of a risk of essentially inflation becoming more embedded unless, of course, there is ongoing pressure on the Fed to essentially ease monetary policy more than would be required by economic conditions.
One off, but not all at once. Sounds like the new transitory, doesn't it?
Well, that's essentially what it is, right? This idea that you might get the trickle-out effect to compensate for higher tariffs, but it won't lead to a protracted higher inflation rate. Basically, justification to look through it.
Greg, appreciate your time.
Thank you.
And congratulations, incoming president of NABE, of course. So we'll hear much more from you in the future, I'm sure. Greg Daco there of EY and the latest in this economy. The latest on this economy we'll see at 8:30 Eastern Time. PPI, CPI in the next 24 hours. It's amazing how few people aren't focused on that data relative to what we've seen in payrolls more recently.
Because of exactly what you just said. If they're going to look through any hot prints and you have a labor market that quite clearly is cooling, well, right now, PPI and CPI are all but irrelevant, which raises the question, how offsides would this market be if it sort of muscled its way into being a little more relevant?
Then that's the question for the next 24 hours, isn't it? That decision about a week away for the Federal Reserve. Coming up next on this program, Jim Zelter, the president of Apollo Global Management, Republican Congressman French Hill, and Lotfi Karoui of Goldman Sachs from New York City. The second hour of Bloomberg Surveillance. Up next.
Equity markets are still in this honeymoon phase.
What's the best liquid nominal asset class? It's equities.
We're pretty constructive on risk assets. There's much more benchmark FOMO going up than there has been down.
We're still looking at a bull market that continues to maybe 6,600, 6,800 by the end of the year.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the second hour of Bloomberg Surveillance starts right now, and your scores look like this. All-time highs coming into Wednesday. Equity futures adding some weight to the rally, up by 0.3%. On the Nasdaq, up by 0.2%. In the bond market, yields very close to the lows for the year. Just about 90 minutes away from economic data, 354.79 on twos. That economic data is just around the corner, 8:30 Eastern Time, PPI. Then on to tomorrow, CPI, a double dose of inflation data coming up.
How high does it have to be before people care about it? That's my ultimate question, because right now everyone's focus is on the labor market and what that means for a Fed that seems poised to cut rates. The debate will be fierce given some of the personnel changes or not on the Fed committee. A question here of how divorced the underlying economy is from some of this corporate development that we see that keeps powering stocks to all-time highs.
So disconnected from what's going on when you look at the numbers from the labor market and the revisions yesterday. A revision on record overstating jobs by nearly 1 million. And this is why the Treasury Secretary has come out and said, basically, the Trump administration inherited a far worse economy than many were expected. Because if you're seeing this underlying weakening in the labor market, this was before Trump was inaugurated earlier this year.
They're not pushing for 25. They're pushing for 50 from this Federal Reserve this time next week. This morning, equity futures positive by 0.3%. The equity market doing better than good recently. Coming up this hour, Jim Zelter of Apollo with investors betting big on a rate cut. Congressman French Hill as a judge blocks President Trump's bid to fire Fed Governor Lisa Cook. And Lotfi Karoui of Goldman Sachs with the Fed keeping a close eye on inflation. We begin this hour with stocks hitting fresh all-time highs ahead of a double dose of inflation data. Jim Zelter, the president of Apollo Global Management, out with a new report asking the question, what if the world doesn't work the way you think it does? Zelter and the team going on to write, the era of free money is over. Ultra-low interest rates are history. Inflation is structural, not transitory. It's redefining risk, return, and the cost of capital. Jim joins us now for more. Jim, good morning.
I got to hire you at Apollo as a marketing guy. You're doing a good job for us.
I'm going to go one step further.
Thank you.
I woke up the other week, came into the office, handwritten note from you, and it said, public markets power the narrative, private markets power the economy. Just start there. What is the question you're posing for clients at the moment? What do you want to get them to think about?
Well, it's a bigger conversation about market structure and the changing backdrops about how investors think about investing from a 60-40 portfolio historically, and the tools they have to create better outcomes with less volatility. The reality is alternatives have worked for 40 years for institutions, and if we think thoughtfully about the growing need for retirees around the globe, how do we augment what's worked well in the past but may not be the compass for the future? On the other side of the coin, it's for companies. 8,000 companies down to 4,000. The role of private capital is changing. Companies like SpaceX and Stripe can stay private for much longer. And so a little bit when I hear about your headlines this morning, I feel like many folks that come on talk a little bit about the world in the rearview mirror versus looking through the windshield. And the real aha moment for us came 2-3 years ago when we saw what was going on with rates rising dramatically in this cycle. And universally, we all thought that the economy would hit skids and there would be tightening financial conditions. And that really didn't happen. So that was a very practical situation where we really said maybe our textbook that we've using all along is wrong. But changing market structure, how companies finance, how investors invest. It is a new playbook, a new paradigm.
Redefining public and private markets. Our good friend Mark Rowan would often talk about this and say often the distinction was risk, higher risk in private markets. And now the distinction I think you and the team want to make is liquidity.
Yeah, I mean, the whole idea when we grew up in a marketplace, this is my 40th year in the business, where private was risky and volatile and public was safe and liquid. And there's many examples right now. I come from the world of credit, and I started out as a high yield / junk bond trader back in the 80s. And it might have been a public security, but trust me, it was volatile and it was risky. And now over 30 years is now junk bonds have become high yield in an asset class. There's still a lot of inherent volatility in that. And again, we would say that across the whole risk reward spectrum. I grew up in Rochester, New York, Kodak, Xerox, Bausch & Lomb, 3 great American icon companies. They didn't get the memo on disruption. They were safe investment-grade companies, and voila, they're not in existence anymore.
Can we talk about how things have changed over the last 40 years? So you and the team would often talk about you are what you originate, you are what you create. The CapEx needs of companies now seem to have changed. I was reading the transcript from your address at a financial markets conference earlier this week, and you talked about the CapEx needs 20, 30, 40 years ago relative to now, and the change in quality, the change in character of things. How important is that, given where we're at?
Well, just to reset that question, in the last 30 years, the high yield market globally has financed companies that are going through either a regulatory change or technology change. Think cable, think shale, think airlines, think telecommunications. And for the most part, that massive CapEx was on non-investment grade companies. As we sit here in 2025 over the next 10 years, massive CapEx boom between data, AI, sustainability, energy transition, transmission lines, the transaction we did for RWE this week in Germany. And so I don't think people are still thinking that private credit and private capital is small, illiquid, non-investment grade companies. And the reality is 80 to 90% of the private credit market is really investment grade counterparties, investment grade debt. And again, many companies now are afforded the opportunity to stay private much longer because of the breadth and the breadth of the financing markets.
To build on what John is talking about, does private debt have more of a role than private equity at this point?
Well, the debt markets and the capital markets and the credit markets are, as the Congress learned in 07, 09, it's the lifeblood of the economy. When GE could not roll over their commercial paper, it was the aha moment for the Congress to say, wait a second, we need to act here. And so when you think about the scope of private credit and scale, certainly the application with investment grade solutions, it's in the multi-trillions, 10 to 40 trillion, and the PE industry is a 7 to 10 trillion, depending on how you think about the dry powder and the overhang. So I would argue over the next decade, the impact of private credit, investment grade and non-investment grade, will probably have as large an impact, if not larger, than private equity has had in the last decade.
So the peak of private equity is over?
Well, I wouldn't say that. I mean, I think that the private equity industry is going to go through an evolution, and it's going to be a Darwinian evolution. And I think that, the challenges of monetization, the challenges of upfront capital commitments, there will be fewer and fewer firms that are able to go to investors and have that dialogue and have that relationship. We believe we're one of them because of our investment track record. But the reality is I think that many PE firms, that business model is going to change, and how can they adapt?
This is a really important conversation to be having, especially because on surveillance, we keep talking about the divide between public markets and the underlying economy. And it seems like it's growing in an increasingly dramatic fashion. And we keep wondering whether the economy is really struggling right now, at least by virtue of some of these labor market pictures, at the same time that you're seeing the oracles of the world do very well. Are you seeing that? Are you seeing the need for money to be a little more free now in order to juice some of that activity?
We're not seeing it yet, but I do think the question you're really asking is, and it is the same question about, with the amount, public markets used to be a great diversifier for portfolios, and it really was the bellwether of how the U.S. economy and the global economy was doing. But as more companies have stayed private and more companies are funding privately, you really are questioning that barometer and what it's telling you. Torsten has a good piece out this morning talking about the concentration of the CapEx cycle and how it's concentrated in a handful of companies in data, AI, and technology. And while the CapEx is a massive number and it's driving a North Star to growth, you're asking a provocative question, is it really hiding the underlying economy, which is driven by private companies? 90% of the hiring in America is by private companies, and is that a different story today? It could be. We're seeing, if you look at the public numbers in terms of earnings over the second quarter, it beat consensus by 700 basis points, 11 versus 4. And for the most part, the credit portfolios that we oversee, the multi-thousands of counterparty risk, 3 to 4,000, it actually showed quality upgrades 3 to 1 versus downgrades in terms of performance. So in the breadth of our credit portfolios, we're not seeing a weakness. I will tell you, we definitely see more lingering inflation. And I do believe that while this administration is dead set on getting rates lower, I believe that there is a legacy inflation issues in the economy. When's the last time any one of us bought something in the last year and you said, wow, that was cheaper than a year ago? It has not happened. And that's just and I do believe that's going to be the scourge of this rate cycle, because I do believe there's greater inflation and companies are having a much more challenging time passing that along to consumers. We're seeing it across the board.
There's a lot to unpack there. One of the things I wanted to unpack was the concentration risk and the AI financing that we've seen both in data centers and the energy transition. There's a quote in the last year that's just stuck with me for the last 12 months, and it came from the Alphabet CEO, that the bigger risk is underinvesting and not over-investing. And that just sounded like a commitment to over-investing. Now, I'd want to understand how your industry avoids a massive misallocation of resources at a time when everyone is chasing the same story.
Well, it still feels like you have a bug in our investment committee rooms. I mean, I've been talking the last 6 months about the cycles of dark fiber in the late 90s, of shale, in the early teens, 12 to 16, and certainly enterprise software the last 5 years. And you have to be concerned as an investor today, are you taking equity risk for a fixed rate of return? That's the ultimate sort of bubble, if you would. And I don't think that the true economics, certainly consumers, industry, the economy is going to benefit, but not all industries as they evolved was it a great investor to be an investor. The cell phone industry is a great example. Only in the last decade has it become a good investment for companies to invest. So I don't have the answer though. It's a question we're asking ourselves. Now we find ourselves both on the debt and the equity side of funding a lot of the data center activity. But there's a tremendous amount needed, and there's a voracious appetite. But I certainly understand what the Alphabet executive was saying.
Do you think there's a bit of a duration mismatch between how long it takes to build a data center and how long it takes to build the energy infrastructure to enable it? And could that be problematic in the future?
There certainly, as we have spent more time, the energy supply issue could be a governor to growth. And that's a challenge that we've not seen yet, but if you pencil out the numbers, that could be a concern. But I think the bigger question is back to the first one we asked is, these are 10, 20, 30-year infrastructure builds. Who really, with our marketplace going towards indexes and ETFs and multi-pod shops that are all thinking about moment-to-moment liquidity, the era of the long investor, it's a question mark. Who is that long investor? And we would say it's the retirees of tomorrow. Every day, 12,000 folks in the U.S., hit 65. And the West, broadly speaking, and other countries around the world have not done a great job with retirees. And so the ability to thoughtfully introduce long-duration infrastructure, inflation hedge assets into these portfolios. In the UK, they call it matching adjustment for insurance assets. Those are really where the growth of our business is going to go, and that's going to benefit investors.
This makes a lot of sense, particularly if you're investing for retirement. You don't need daily liquidity. That's just logical. I think where the criticism is coming from for your industry at the moment is that family offices are already doing a lot of this. I think you and the team have talked about that a ton. High net worth individuals are doing the same. You're now going after retail. And then people start to feel a little bit uncomfortable with that. Are you looking for a new bag holder? Are we looking for someone else to pick up the pieces? What's the response from you and the team to address that head on?
I think it's all about doing it in a methodical, logical, diverse way. This is all about the proper amounts and the proper diversity. Certainly, we would never advocate for someone taking an outsized portfolio of their retirement and putting it all into alternatives. But clearly, over the last 30 to 40 years, history has shown us that an allocation to alternatives, 10 to 20% of a portfolio, increases returns and brings down volatility. And so from our perspective, there's a variety of areas in the world of credit in particular, the world of infrastructure, the world of secondaries that are more yield-oriented, compounding type of vehicles. And certainly we have a view that private equity, while a very attractive asset class, even in returns over the next decade, mid to high teens, that should be done in appropriate doses. So it's all about diversity and proper portfolio allocation.
We've got no bugs in the boardroom, don't worry. Jim, it's good to see you. You're going to stay with us. Jim Zelter of Apollo, perhaps. Perhaps not. All right, let's get you an update on stories. We don't. Elsewhere this morning, with your Bloomberg brief, here's Vonnie Quinn. Hey, Vonnie.
Hey, John. Thank you so much. French President Emmanuel Macron has named Sébastien Lecornu to be the country's new prime minister. Lecornu, a defense minister, will become the country's 5th prime minister in 2 years. The last 2 premiers were ousted after trying to pass budgets that would sharply reduce France's deficit, the widest in the euro area. A judge has temporarily blocked President Trump's effort to remove Lisa Cook from her position as a Fed governor. The ruling allows Cook to remain in her post while she challenges the White House's attempt to oust her over allegations of mortgage fraud. The judge found the alleged misconduct likely does not amount to cause for her removal. Top lawmakers are opposing President Trump's proposal to fund the government through January 31st. The pushback increases the risk of an October 1st government shutdown. The White House's plan calls for a series of changes to funding levels and is more than 2 months longer than lawmakers on both sides initially wanted. And that's your Bloomberg brief. John.
Vonnie, thank you. Up next on the programme, fast-tracking a tariff review.
I'm confident the Supreme Court's going to go with us. We do have a fallback position. It's more cumbersome, and I think it limits the president's hands to do these great deals.
Up next on the programme, we'll have more from Jim Zelter of Apollo, live from New York City this morning. Good morning. Live from New York, equity futures positive by 1/3%. The economic data 1 hour and 11 minutes away. Futures up across the board, on the Nasdaq at least. On the Nasdaq up by 0.2. Small caps, some massive underperformance as we closed out summer. Some underperformance this morning. We're down by about 1/3%. Summer, by the way, just for the record, continues.
I know. You're going to say that September 21st.
Holding on
it's
to that.
Absolutely ridiculous. And you're wearing black, so I don't see you wearing a white suit.
This is all year. It's not seasonal, okay? Under surveillance this morning. You know that. Fast tracking a tariff review.
I'm confident the Supreme Court's going to go with us. We do have a fallback position. It's more cumbersome, and I think it limits the president's hands to do these great deals. What a tragedy it would be to be overruled on this. I think courts are very reluctant to overrule a president's signature policy.
So here's the latest this morning. The Supreme Court fast-tracking a challenge to President Trump's global tariffs. The court agreeing to hear arguments in the first week of November.
So that's music to the ears of this administration, especially the Treasury Secretary, who has talked about the fact that actually this is infringing on how they are negotiating right now with some partners. As he said, this is one of the president's signature economic policy proposals. And the Supreme Court is going to decide, Jonathan, whether or not they're legal or not. And what they want to see is that they want to know as soon as possible. They don't want to be at the very end of the court's term next summer. So we're going to start that hearing about this at the Supreme Court in November. So it is a very fast track for the administration.
Jim Zelter, the president of Apollo Global Management, still with us. Jim, let's continue this conversation. At the start of the year, you talked about macro paralysis. This story is continuing. It just feels like this market, public markets, have moved on. Have you and the team moved on?
Yes, I think if you landed from Mars today and you had not had the benefit of the last 6 months, the idea of the death of U.S. exceptionalism would not be on your radar screen, and you'd have 4 or 5 things. You'd say massive CapEx cycle in front of us. You'd say administration pro-business and determined to cut rates. You'd say that the last quarter's public numbers in terms of equities and credit have been strong. And you'd say there's a big M&A pipeline, and we're on record to have the second biggest M&A year versus 21. So all those things would point to invest, rates are going lower, spreads are going to stay tight, and I can give butts to all of those, but that's the trend going on right now. And the idea that investors were going to boycott the U.S., FDI has been massively strong the last 4 or 5 months, and knock wood, we've had a very strong year across our public and our private businesses. A lot of origination. This week, we led a very large transaction for RWE, which is exactly what we're talking about big private solutions, energy transmission, a very exciting business. It's a blockbuster business, one we would never have talked about years ago, but they have billions upon billions of needs to restructure the transmission system in Germany. So the markets are, the animal spirits are back. There are lots of little hiccups out there, and whether it's instability or valuations or other headaches. But yes, active market. We've been active in the U.S. and Europe dramatically this year, and the pipeline is quite strong.
Have you found the need to hedge from the U.S. a little bit more, given the fact that there is this policy uncertainty, but more so this question around the Fed cutting rates, allowing inflation to run hot, and a depreciation of the dollar?
Mm-hmm. Certainly there's been a lot more hedging of investments from overseas investors. And certainly, we typically, because most of our liabilities are in the dollars, we will hedge back to the dollar as well. But we certainly want to have exposure to other economies in addition to the U.S. because of the concern about inflation.
Do you think this is the real deal in Europe? I get the feeling you do.
Well, there was an interesting article I read this morning that a year after the Draghi report, like 11% of the proposals have been put in place. So I think companies I see corporate leadership in a variety of sectors, and I see a few government leaders, passionately pursuing this. But I think the overall pace is not what it should be. And the paralysis of the broad government oversight in Europe is holding the progress back. So it's not as fast as we would like it, but it's a train we want to be on.
What would be an easy change to make that train go faster?
They've pushed for a variety of relaxation of some of the securitization rules. Basically a Solvency II balance sheet for an insurer in Europe. You have to own almost 65 to 70% of your assets need to be sovereign bonds. That's just too large an amount, and it's very, very challenging and difficult to purchase and to hold securitized product, asset-based securities, which have proven to be a very good tool for insurance companies and other financial services firms in the U.S. It's good for dispersing risk, and it's good for versus corporate purchases. So I think something like that, securitized products, would be a very easy and important move to make.
I think, sadly, many of us just conditioned by experience, conditioned to be disappointed by Europe.
Are we allowed to be disappointed? I keep thinking about what Howard Marks said after they announced the regime of tariffs. And he said, the U.S. is still the best place to invest, but it's less of a best place to invest. And so you start looking at other places and saying, yeah, there's hair on this. They're not going to get their act together, but at least there's some investment and we might as well diversify. And I wonder how much that's driving people to like what they're seeing, even when there still is a lot of skepticism.
Jim?
I would say they've looked around. They still come back to the U.S. Strongest, largest, deepest market in the world, greatest economy, rule of law, unbelievable banking system, creativity, intellectual capital. It's the place to invest.
That
He's running.
Sounded like a politician's speech, didn't it?
Yeah, maybe for mayor.
Yeah.
He's still diversifying.
Run, Jim. Jim Zelter of Apollo. Jim, thank you, sir. You don't want anything to do with that. Up next, a man who will want to engage on that topic, Congressman French Hill, as Fed Governor Lisa Cook keeps her job for now. That's next. This is Bloomberg. Economic data about 60 minutes away. Equity futures positive here by 1/3% on the S&P. On the Nasdaq 100 up by 1/4. In the bond market, 2-year, 10-year and 30-year bond yields settling down. We're down about a basis point at the front end to 3.55. But check this out in Europe. Italy versus France. 3.48 on French debt. 3.48 on Italian debt. The convergence. If you go back to the Eurozone debt crisis, this was 4 percentage points. That was the spread between the two, Italy trading over France, and now these two trading right in line with each other. Do you remember that line about hard men making easy times? Hard markets make tough leaders. Tough leaders make easy times. Easy markets make weak leaders. Weak leaders make hard times. That's the situation in Europe. over the last 10 years.
That's pure poetry, John. It just rolled off the tongue. I mean, there's this question here of whether France has what it needs to pull its act together at a time when their borrowing costs actually exceeded Italy's for a brief second yesterday. And some people are saying it's because of a roll and these technicalities. Nonetheless, the reality is stark for France. And right now, there are protests that are gearing up across Paris to protest some of the cutbacks from Bayrou, who already is out as prime minister. So a very difficult moment to really understand exactly what the political response mechanism is going to be.
Yeah, I think the thing I'd like to emphasise this morning is less of what's going on in France and more of what's happened in Italy, in Greece. They went through the hard times. The leaders had to make the tough decisions. That's why things are so much easier now compared to, say, France. France had problems 10 years ago and the markets gave them a pass. And guess what leaders became? Weak. Didn't do enough to address the issues. Where are we 10 years later? Big problems. That's the issue we've got at play now.
So you're going to invest 10 years out in France because you think that they're going to get their act together and take the lessons of Italy and Greece?
I don't know if we're at the point where markets are hard enough to make leaders strong enough to make the kind of decisions we need to make times easier.
You know, it's a good point. It's what a lot of people are wondering. This game of chicken between markets and politicians. And at what point is the pain in bond markets enough to spur some sort of action? And it seems like, based on the protests, some of the ramifications, not there yet.
That was enough of that. It's on the edge of Joe Rogan, wasn't it? OK. French yields this morning up by a basis point or so to 3.48. 2 hours away from the opening bell. Let's get you some morning movers with Yahara. Hey, Yahara.
Hi, John. With this massive rise in Oracle shares, up more than 30% in the pre-market, it is set to add about $200 billion to its market cap. That would mean it would be the 10th most valuable member of the S&P 500, and that is all thanks to a very bullish outlook from this company. Its booked revenue is up 359% from the same time a year ago, climbing to $455 billion in the latest quarter, and that is thanks to massive cloud deals with the likes of NVIDIA, TikTok, and OpenAI, just underscoring the strong demand for compute power. And we stick with tech, but this stock is moving in the other direction. Synopsys is down 23% as U.S. export restrictions weigh on its China business. No surprise there. That is because this is a company that provides tools to design advanced semiconductors, putting them squarely in the crosshairs of Washington's efforts to curb China's access. And those measures have been on and off again, creating uncertainty for this company and its customers. And we end on the original meme stock, GameStop, up nearly 11% after reporting a big jump in sales, more than 20% compared to the same time last year. And that was thanks to a boom in hardware sales, because during this time was when the Nintendo Switch 2 came out. And as we all know, that flew off the shelves. John?
Yahara, thank you. Thanks for the update. More from Yahara in the next hour. On our radar this morning, some of our top stories. President Donald Trump asking the EU to impose 100% tariffs on China and India in order to push Russia into negotiations with Ukraine. The White House saying it will match any tariffs imposed by the EU on the two countries. Elsewhere, the Senate Banking Committee voting today on Stephen Murren's nomination for Federal Reserve Governor. The move likely setting him up to be confirmed before next week's FOMC meeting. And finally, Apple shares slipping after the unveiling of the new iPhone 17 at its annual event. In a key change, the company swapping out the iPhone Plus for the iPhone Air, which Apple says is its thinnest ever.
Some of the commentary from the likes of Samsung and Google were savage. That's all I can say. The advertising, the counter-advertising, if that's it, that's all you've got. What I thought was the most interesting is that prices didn't go up on any of these products except for the highest end. What this highlights to me is an awareness of a pushing back in price, even as they have their heroin chic phones, their really ultra skinny phones that are the iPhones 17. Some positive reviews, some questions around battery life. The bigger question is, this wasn't a big enough innovation to really turn the dial.
What was the innovation? Cosmic orange iPhone. It's a little bit thinner, has a better battery life, which every single iPhone that comes out should have a better battery life. I mean, does this really make you want to go line up and get a new iPhone?
This is not a moment for hardware, is it? This is meant to be the moment for software. Address the issues, and you're not seeing the incremental developments that people want to see in order for them to upgrade. We'll catch up with Dan Ives later this morning. Dan's been talking about a super cycle of upgrades for years now, and we haven't seen it.
Yeah, and the question is, can they innovate at the WWDC, the developer conference, to really put forward something like a phone or a robot, like we were talking about yesterday? Because is it still the phone that is the device, that is the hardware that's really going to turn the dial? They also were putting out there some Apple Watches that have better tracking devices for your sleep and other things that some of us neglect.
I like the headphones. Do you see what the headphones can do? Real-time translation. You speak back, and then you get the translation on the phone for the person you're talking to when you're abroad. I thought that was pretty cool.
Do you think that we're ever going to learn language, or that our kids are going to learn language in school, or do you think that they're just going to be able to translate it?
I thought about that yesterday. I was looking at this playing out, and I just thought it's slicker if you walk into, I think the video was from a florist. Did you see this video?
Yeah.
I think she walks into a florist. Isn't it slicker and just smoother just to be able to speak the language?
Yeah, very much
Instead of holding up a phone with the text coming up.
Yeah, although I've been in situations where that would
Unless they have the headphones too.
Oh, and then
you
everyone
have the
just
headphones and we just walk around with
Again,
those.
we just become robots.
Yeah, with white AirPods in our ears. OK. Let's turn back to Washington. Federal Reserve Governor Lisa Cook staying on the job after a judge temporarily blocked President Trump from removing her. Congressman French Hill, chairman of the House Financial Committee on Financial Services, joins us now for more. Congressman Hill, welcome to the programme, sir. I've got a lot to get through, and I just wanted to start with the independence of the Federal Reserve and the role that your committee's got to play as this spat continues to build down in Washington.
Well, good morning, Jonathan. Great to be with you. As you know, I've spoken out many times about the importance of the independence of the Fed, and so has my colleague across the Capitol, Tim Scott, the chairman of the Senate Banking Committee. But because we fully support Fed independence doesn't mean the Fed's immune from criticism. And every president in my adult life has been very vocal about criticizing the Fed at one time or another. So I don't think Fed independence is in question.
When it comes to what could actually happen in terms of financial stability, we have Fed Governor Lisa Cook's lawyer saying that the president was unlawful in removing Governor Cook and said its vague allegations would endanger the stability of our financial system and undermine the rule of law. Do you agree with that assessment?
Well, I think there's some hyperbole in there. Lisa Cook has been accused of effectively mortgage fraud. Those are significant allegations for someone who is a financial regulator, but I think they need to be adjudicated. I mean, she needs her due process, her day in court to prove that in fact that's not the case. And I think that's underway right now, and that's again something I've said in recent days.
Do you think the president should have waited for the courts to play out in terms of this investigation, for these allegations to actually become charges and a conviction, to then take up this idea to fire her for cause?
Look, the president's entitled to his own opinion. He has access to the facts that probably I don't, so he's made his decision about it. But my judgment is that's a serious allegation, and if true, it's certainly potentially a disqualifying allegation and charge for someone who's involved, very much intimately involved in the federal regulatory process.
Taking a step back, though, do you agree with the Treasury Secretary on resetting the Fed's mission?
Well, you know, I've believed that for a long time. I believe the Fed should have a single mandate, which is price stability. The biggest, most punishing tax on the American people, our citizens, is inflation. And inflation's caused by too much money chasing too few goods, and we've had a dramatic example of that by Fed policy during the pandemic and the Biden administration's fiscal policy in combination. Very punishing, 40-year highs in inflation. So I believe we need fewer mandates, and I think we need that monetary policy focused on price stability. Again, that's why I set up a task force in this Congress to review the Fed's monetary policy since 2008, review the Fed's role in financial regulation and supervision, and to make sure that we're also taking steps to make sure our Treasury security market is resilient. All this work is led by Frank Lucas of Oklahoma, and we're deep in that process. So I think taking a strong look at the Fed's monetary policy and their governance, it's an important factor, and I agree with the Treasury Secretary on that.
Well, inflation has not been below 2% for more than 4 years at this point, and we're still talking about 50 basis point rate cuts, maybe 75 basis points of rate cuts this year. Do you think that that's premature if this should be a single mandate Federal Reserve that looks solely on inflation?
Well, I think this is the tough decision they have coming up, and we've seen a softness in the economy during the whole year in terms of consumers' ability to purchase, the jobs reports that we've gotten. This is why the Fed chairman, I think, consistently has said, let's look at the data, look at our data assessment and the forecasts associated with it, and also make our own judgment about whether we're at the neutral rate for pricing, because we don't want to see the economy stall out and then go into stagflation, particularly when you're right about inflation getting close to 2 but not below 2 and not right at 2. But when you look at inflation expectations, they seem to be more closely anchored at 2, and that should give the Fed some confidence as they entertain their decision in the next few days.
Chair Hill, I know you and your colleagues almost just recently got back from summer recess, but October 1st is fast approaching, and the Trump administration is weighing and pushing for this idea for a stopgap funding measure to keep the government open through January 31st. Would you be on board with that?
Well, we're talking about it among ourselves and obviously with our friends in the Senate. We've each passed 3 appropriations bills in the Senate and the House. I think it would be great to go to conference on those bills and then pursue, get those enacted into law, and then pursue a CR that's a shorter term CR would be my advice for consideration, so that we can get this work done. We're very close. Both the House and Senate are processing these bills. We have the Republicans in charge of the House and the Senate and the White House, so we ought to get together, find our top line number, and get our work done this year.
Congressman, before you go, the important stuff, Arkansas football. Razorbacks going to get done this year?
Really enjoyed watching the quarterback come and have his great game against Arkansas State. This was the first time in Arkansas history that Arkansas State played the University of Arkansas in Little Rock at the famous 1949 War Memorial Stadium. It was a fantastic day. He looks pretty good. We play Ole Miss this weekend, so that'll be the first SEC game, and that's where the rubber hits the road.
Saturday, 7 p.m. Looking forward to it, sir. Thanks for being here. Congressman French Hill.
You still need to come to a Razorback game.
I've got to make it happen. I know. This year it's got to happen. Thank you, sir. SEC football.
All the best.
Thank you. Appreciate it. Got to make a game happen this year. Team trip. I'm not going to do like the team cruise we've talked about a million times. I will do a trip down to some kind of SEC football game before the year is out.
So you'll be there. I'll go to Bentonville.
It's got to be Arkansas.
Arkansas or Ole Miss this weekend.
I could see you there. I feel like you have like sort of a southern sort of undertone. I could see that.
Possibly. I think I relate to that. I think it's probably the closest thing in this country to European football.
Oh, because of the small kind of
SEC
natures,
football,
yeah.
totally.
Yeah,
the connection with your team.
Yeah, that's what you
stuff.
do on the weekends.
I can't connect with the NFL at all. Just the idea a franchise can move from city to city, state to state, just doesn't speak to me.
Yeah, the fact that the New York team actually plays in New Jersey bothers you. Yeah,
I just can't get my head around that. All right, let's get you an update on stories elsewhere this morning before I offend someone else. With your Bloomberg brief, here's Vonnie Quinn. Hey, Vonnie.
Hey, John, thank you. President Donald Trump said he is very unhappy about Israel's strike on Hamas targets in Doha. Trump said he learned of the attack too late to stop it. The president spoke with both Israel Prime Minister Benjamin Netanyahu and Qatari leaders after the strike and assured Qatar that such an attack would not happen again. JP Morgan and Barclays among banks bracing for potentially hundreds of millions of dollars in combined losses from loans tied to subprime auto lender Tricolor. Sources telling us here at Bloomberg the banks are warehouse lenders for Tricolor and are looking into whether the collateral for the lines was double pledged. Novo Nordisk will cut some 9,000 jobs globally, 11% of its workforce, after slashing its profit forecast for the third time this year. This as it fights to recover lost market share from Eli Lilly in the obesity drug market. The pharma giant plans to save $1.3 billion by the end of next year and to reinvest in new drug development and sales. And that's your Bloomberg brief. John.
Vonnie, thank you. More from Vonnie in the next hour, about 30 minutes away. Up next, phantom inflation.
They're kind of worried about like the phantom inflation expectation story or, the threat of potential inflation coming from tariffs. I mean, I think those are really secondary considerations at this point, given what we're seeing in the jobs market.
In just a moment, we'll catch up with Lotfi Karoui of Goldman Sachs from New York City this morning. Good morning. You're watching Bloomberg TV. Session highs on the S&P 500 up a third of 1%. Likewise on the Nasdaq 100 this morning, coming into Wednesday at record highs. Up a third on the S&P, up a third on the Nasdaq. Under surveillance this morning as we count down to PPI and CPI phantom inflation.
They're kind of worried about like the phantom inflation expectation story, or the threat of potential inflation coming from tariffs. I mean, I think those are really secondary considerations at this point, given what we're seeing in the jobs market. So to me, I think the risk is that the Fed ultimately won't deliver as much as they should, and that kind of reinforces the slowing that we've already seen.
So here's the latest this morning. Investors looking ahead to a double dose of inflation data due out in the next 24 hours, with just 1 week to go until the Fed's next decision. Lotfi Karoui of Goldman Sachs joins us around the table for more. Lotfi, good morning.
Good morning.
Got a lot to talk about in your world in credit markets and broader fixed income. Let's just start with the Federal Reserve a week away. Neil Dutta of RenMac called the inflation phantom inflation. He wants this Fed to lean into the weakness in the labour market. Where are you and the team at?
Yes, I think that would be our view, too, which is that reaction function is definitely more tilted towards the weakness in the labor market as opposed to potential upside, risks from inflation. I think 25 basis points is pretty much a done deal at this point. We expect them to follow suit with another 2 hikes in October and December, and then 2 more in 2026. Now, a lot of that is in the price. And so I would say relative to the last 6 months, the risk reward in that front end of the curve feels probably the most balanced to me at the moment.
Do you think that what you're seeing in the individual companies that you invest in, the sort of credit aspect of this, verify the weakness that we see in some of the numbers about the labor market, about the underlying economy?
To some extent, yes, but not a lot, to be honest with you. I think whether you talk to investors or corporate issuers, the message that you're getting is that we're happy or we're comfortable with this weak but not too weak equilibrium, so long as it comes with monetary easing, so long as we remain far away from the recession threshold. And then you have some of the offsetting tailwinds kicking in later into the year, and that's really expansionary fiscal policy and deregulation. And so most folks are actually willing to look through the current weakness and sort of, focus on 2026. And I think that's the right approach, because you will see a growth acceleration in 2026.
Does this justify how tight spreads are, how much people are buying credit with the hope of that reacceleration?
Yeah. I mean, look, generically, credit is an anti-recession asset class. When you buy credit, you're owning a put. And so you're a lot more sensitive to downside risk than upside risk. I think the comfort that everyone has is that you're still far away from that recession threshold. And so, yes, to some extent, it is justified in my view.
When you talk about deregulation and the fiscal input coming from Washington, where exactly do you see that?
Well, I mean, on the fiscal side, you got, tax policy is going to turn expansionary.
But it's just really an extension of policy, isn't it? What's new?
To a large extent, yes, but you do have a little bit of a growth impulse. And then, look, growth has slowed down this year, too. And so the starting level is actually lower than 2024. I think, we're sort of oscillating around 1.5% here. We will probably, revert back to trend growth in 2026.
Coming into 2025, I still remember your outlook. And you talked about the valuation proposition in credit being some of the worst you've seen for years and years and years. And as we sit here today, spreads just got tighter and tighter and tighter. You scratching your head at all about what you've seen so far?
No. I think, look, we've been range bound. The range, if I take the investment grade Bloomberg index as an example, the range has been 75 to 90 basis points. I still think that the risk of a valuation melt up, which is something that you increasingly hear, so spreads going to literally uncharted territory, is very, very low in credit. If anything, you should see some M&A supply kicking in the next, couple months. So from a technical standpoint, it won't feel as imbalanced as it is today. But I still feel pretty good about that. I think, look, as a spread investor, you have to be cognizant that valuations are not great.
So the trajectory of benchmark rates seems to be heading downward. We are going to get some Fed easing. The bigger question for a lot of investors, and Jim Zelter of Apollo was on just earlier, saying he's concerned about inflation. And he thinks over the longer term, if you cut now at a time where there still is enough resilience and potentially some of the impulse that are coming through later this year and early next, you could get a really sticky inflation. How much is that a risk scenario to what you're just putting out there?
It's always a risk. I mean, our baseline view is that tariffs, in the end, are sort of a price level effect. So, think of them as like a VAT, transitory. I know, that's sort of a. But more importantly, we don't think that will translate into structurally higher inflation expectations. But of course, you cannot rule out that risk. I think the Fed has gotten to that same view too. It's really less about spot inflation, which will mechanically increase on the back of tariffs, and more about inflation expectations. And at the moment, those will remain anchored. I think that's the view.
There's also been a big debate about the U.S. versus Europe, and that's something that we were talking about with Jim, the idea that the U.S. is still the cleanest shirt in a dirty laundry bin. I'm rolling my eyes because everybody says these cliches. But at the same time, you might want to increase your exposure to Europe just by virtue of having that additional hedge. Do you think that's gone too far, especially with the political instability?
You're seeing it in the data. I think there's no question that the marginal dollar, and I would emphasize that this is about the marginal dollar. So the new dollar that you're allocating is getting allocated in a more balanced way. And we see it on the private side. If you look at the data, Europe is definitely attracting more capital. Would I go as far as saying that we're on the verge of a massive rotation away from the U.S. back into Europe? Probably not. I'll give you a very concrete example. Look at leveraged finance markets. In the U.S., it's $4.5 trillion. If you add up high yield bonds, broadly syndicated loans, private credit, in Europe, it barely exceeds $1 trillion. So in terms of size, in terms of depth, in terms of fragmentation, I do think that the U.S. still scores way better than Europe.
Lisa's talking about sources of demand. Can we talk about sources of supply and some of the issuance shifting over to Europe? What are they called, reverse Yankees?
Yeah.
What's going on with that kind of debt issuance?
There's a variety of narratives that you're probably hearing. To me, the biggest driver of that surge in reverse Yankee issuance is really the willingness of large multinational corporations to diversify their currency mix, full stop. I don't think it's about sort of the yield differential between the two. A lot of these companies actually do have a big chunk of their revenues that come from the euro area. You're just looking for ways to diversify a little bit, and I think that's what's happening. But, reverse Yankee issuance is on a record high pace at the moment.
It's unbelievable, the amount of supply we've seen from US issuers over in Europe.
Yeah, and what Lotfi is saying is it's more of a currency hedge than it is anything else, which is really interesting. The idea that if you're selling into a continent, you might as well keep the currency the same, especially given the dollar weakening trend.
Seen some serious weakness. Euro dollar back up at 117 this morning.
Are we on 120 watch? That's what I keep wondering.
We've been on 120 watch consistently. The ECB pushed back against that. Have you noticed that? And since then, kind of been like this ceiling for that currency pair.
Yeah, whether they continue actually mentioning it. They never mention the currency until it hits close to that 120 mark, and then they start getting yippy. I think that the interesting thing to me is at what point do people stop traveling to Europe because of the currency?
I think that's the interesting thing exclusively to you. I think that feels very, very personal.
I'm just wondering, at what point does that affect the supply-demand dynamic when it comes to tourism?
Serious issues. Let's book a guest. Let's make it happen. Lotfi, it's good to see you. Thank you, sir. Lotfi Karoui of Goldman Sachs. I'm right there with you.
Hey, come on, you think about
the
that.
Other
people do too.
The hard-hitting journalism
100%.
For the summer of 2026. Coming up next, Deepak Puri of Deutsche Bank, Dan Ives of Wedbush, Seth Carpenter of Morgan Stanley, Lisa Hornby of Schroders. The economic data in America, 34 minutes away.
There's a huge difference between what's going on Main Street and what's happening on Wall Street.
The general health of the economy, it's broken down.
We're expecting a prolonged period of elevated inflation.
We have an eye on the inflation data, but the one data point is not going to, I think, derail the path.
I don't think inflation is getting away from the Fed, which is why I think they should be focusing more on the growth side of the economy.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning to you all. The third hour of Bloomberg Surveillance starts right now, and your scores look like this. A two-day winning run on the S&P 500. 5 days on the Nasdaq. Futures up again by a third of 1%. In the bond market, 2s, 10s and 30s. Two-year bond yields very close to the lows of the year. Just north of 350 this morning at 354.79. Yields down a single basis point. We are 30 minutes away from the economic data. The next stop for the big economic debate, PPI at 8:30 Eastern Time.
Does it matter? I think that is the key question. How high does that number have to be for it to matter at a time where there seems to be an inflation independent, to an extent, Federal Reserve that is squarely focused on the labor market. Yesterday's labor market revisions only underscored the sense that there is enough of a weakening in the employment sphere that they really can look past some short-term inflation.
The decision is a week away, a week today, and this is what the Treasury Secretary Scott Bessent's got to say about it. If the Fed is data dependent and the data is bad, make-up rate cuts are needed. 25's not going to cut it. The administration wants more than that.
They want more than that because they're looking at these revisions and they're saying if the Fed had had this type of data earlier, they would have been cutting sooner. So they should be making up for the lost time. When the facts change, I change my mind. That's what the Treasury Secretary said yesterday on Fox News. All of this, though, is going to be so much more interesting, I think, because of the personnel. We're going to have Stephen Myron potentially today clearing a key Senate hurdle. Lisa Cook, a judge last night, said she could stay at her job. Are they going to be there to vote? And likely they're going to be dubs. So they're going to be voting for a rate cut. But whether or not it's 25 or 50, that remains to be seen.
If we do have a Governor Myron walking into that meeting next week, he can ask a very simple question. If we knew then what we know now about payrolls growth, where would rates be? Would they be lower than they are now? And the answer for a lot of people might well be yes, which raises the question, I think, about 25 or 50. I think some people will be pushing that issue at next week's meeting.
If Stephen Myron is there, he certainly will. Will Chris Waller? That will be an interesting question. Will Mickey Bowman, another potential contender to become the next Fed chair? Will the market start to price this in? And at what point do we worry about inflation once more? I mean, really, again, we're talking about this all ahead of PPI coming out today, a question of how much we have the ability to, or for companies have the ability to pass along price increases, and then CPI, how much consumers are eating it. Tomorrow, these are going to be important linchpins to understand the longer-term trajectory for the Federal Reserve.
Shouldn't change the conversation. Not because I believe it shouldn't change the conversation. Shouldn't change the conversation because of the way the chairman has laid out the reaction function of the Federal Reserve at Jackson Hole. When you come out and say this is basically going to be a one-off but not all at once, you're basically saying even if we get hot prints between now and year end, that's not going to stop me from maintaining a focus on the labor market.
Yeah, and this is a reason why a lot of people are seeing a Fed cutting rates and are believing what the Fed is saying, and they're not necessarily selling long-term treasuries. That's one thing that has given a lot of people confidence. My question is, what is the reaction function next week from the markets to any kind of outsized rate cut or an indication that they're going to continue to cut? Because ultimately, it's fine if Fed Chair Jay Powell says it. Does the market endorse this idea of a one-time kind of price adjustment?
At the moment, just about. 30-year bond yields backing away from 5% over the previous 2 weeks. We're back down to about 4.73. Coming up this hour, Deepak Puri of Deutsche Bank as stocks trade at all-time highs. We'll speak to Dan Ives of Wedbush as Apple falls following its new iPhone unveiling, and Seth Carpenter of Morgan Stanley as we break down the latest inflation data. We begin this hour with stocks steady as traders await a key week of economic data. Deepak Puri of Deutsche Bank writing the following. Given signs of a weakening labour market and a moderating economic outlook, we expect 5 cuts until September 2026. Deepak joins us now for more. Deepak, good morning.
Good morning.
Good to see you, sir. How quickly do we get that kind of move? Do you think it's 5 cuts spread out evenly, or could they just move, say, 50 right now? Let's go.
I think the bar for a 50 right now is pretty high. So I would be more inclined to say it's a bit more spread out, maybe 2 to 3 rate cuts for the rest of the year, and then 1 cut per quarter for 2026. This is going to September 2026. And the reason I say the bar is pretty high for 50 basis point, because, we cannot be focused too much on a lagged release on the labor markets, which is a lagging indicator to begin with. So I think the markets are not going to be focused too much. Yes, from a Federal Reserve perspective, maybe it's going to have a lot more discussion, and that'll be, available to us when the minutes are released.
Sure.
But I think in the near term, I still believe, given the inflation backdrop, the fact that the assessment of where the tariff rates are going to hit and really base upon what would be the impact of the pass-through of those tariffs on inflation, it's still a little bit TBD. So I think it'll be pretty much premature to start cutting aggressively at this point.
If we hadn't had Jackson Hole, I think a lot of people would agree with you. But the language that the chairman used with regards to inflation has got a lot of people thinking that he's just going to ignore those hot prints. Is that the wrong interpretation of what we heard in that speech?
I would tend to agree with that. I think what Jay Powell said in Jackson Hole is saying, yes, we are eliminating average inflation target. It's now inflation target of 2%. Having said that, inflation is still the mechanism for full employment. you have to look at full employment through the prism, through the lens of inflation. So first and foremost, yes, for the time being, if you're looking at, the federal dual policy mandate, maybe labor markets are gaining more credence. But overall, it hasn't really said that inflation is not going to be part of this analysis. I feel the markets may be, overestimating the dovishness of that speech.
If the Fed does cut 5 times by September, does that essentially underwrite risk assets?
To a large extent, yes. But we have been saying that don't fear the pause, fear the cuts. And the reason we are saying that, Lisa, is because when the Fed starts to cut rates, a lot depends on why they are cutting rates. Are they cutting rates to tame inflation, or are they cutting rates because they feel that the labor markets are declining so rapidly that it's going to start having an impact on overall economic activity? And I think that sort of analysis is to be determined in the sense that for the time being it sees that the labor market is gaining more momentum in their thinking. If that remains somewhat muted, meaning the second half of the year is the economic activity is somewhat of a soft landing, let's say, before it reaccelerates in 2026, I think you'd see a bid up in risky assets. And not only that's one of the reasons, there are 3 or 4 other reasons why I feel, stocks and risky assets could do well. You look at the capex spending, you look at the earnings growth, the strength of the balance sheet of both households and corporations, plus the fact that eventually you're going to see this rate cut regime. All these talk about a positive risk scenario. So you don't want to be overly bearish at this point in the cycle.
Based on what you're describing, it raises the question, can you have your cake and eat it too, right? I mean, can you have bonds rallying at the same time that stocks are rallying on the heels of Fed rate cuts, or do you essentially get stocks doing well, sell the long end, and by God, do not hold any dollars?
Yeah, I mean, that has been the case. If you look at the last 15 years, there have been a lot of time frames where both bonds and stocks have rallied. Those correlations that we used to have, there has been a breakdown. And you can also see it in 2022, where both stocks and bonds really fared miserably. So I think the fact that stocks rallying means that the bonds couldn't rally is probably a misnomer at this point. We have seen the evidence to the contrary.
How uncomfortable is it, given the picture Lisa's talking about, with the fact that we are really in a weakening labor market? Going back to May, it's sub 30,000 jobs added to this economy a month on average.
Yeah, I think that's one point of the labor markets that is a bit more, concerning. But if you look at a lot of others, look at the initial claims data, the high frequency data on labor market, that is still not, at least to me, telling that the labor market's in a perpetual decline here. I think we need to take into account that post-pandemic, the data is noisy with regards to labor markets. So I'm not saying labor markets are not they're not as strong as they used to be, but they're definitely not suggesting to me that we are in a recession or in an imminent recession, whereby, to our earlier conversation, the Fed needs to step in aggressively.
So then why is the Fed cutting if inflation is still above their 2% target?
Well, they have to do a preemptive insurance rate cut, because even though what they don't know is the trajectory of what the impact of labor market softness is going to be on consumption. And I think that's the linkage that they're trying to, give the market some sense of relief and comfort that we are there. We don't want, yes, we would like to tame the inflation, but for the time being, our focus is directly on the labor markets.
12-month price target, 6,800 on the S&P?
That's correct.
That's very small upside, with about 125 basis points of rate cuts. Why is that move not sufficient enough to generate more returns in equities?
Well, the sentiment positioning, the fact that we're looking at a valuation level that's above 23 times, so the argument that earnings can only pull the stock market up to a certain level. You also need a PE expansion, and that's difficult to see at these levels. So I think you want to be at least positive. As I said earlier, you don't want to be overly bearish, but I don't think it's also a very high conviction with regards to all chips in place. I think any sort of a pullback makes a big case for the markets to go up, and we'll be a buy at that point.
You've been in this business a long time. Have you ever been as confused as to how to handle an environment as the one we're in right now?
There were confusing times, obviously, 2009, 2011, right around the pandemic. So there have been times that give you conflicting data signals, right? But I'll zoom out and look at the way the stock markets react in a longer time frame. And I think we all know stock markets and real economy are two different things. When I look at the money supply, when I look at the financial conditions, when I look at the strength of corporations, to my earlier points, it's really difficult to be overtly bearish. Yes, the real economy, one could argue, half of the households are doing great, maybe the other half are not. But I think the momentum with which the markets are going, the drivers are a lot different than the real economy.
Deepak, it's good to see you.
Likewise.
It's been too long. Come back in soon.
Will do.
Appreciate your time. Thank you. Deepak Puri there of Deutsche Bank. Let's get you an update on stories worldwide this morning with your Bloomberg brief. Let's cross over to Vonnie Quinn for more. Hey, Vonnie.
Hey, John. Thank you. President Donald Trump told European officials he's willing to impose new tariffs on India and China to push President Putin to negotiate with Ukraine, but only if EU nations do so as well. Other potential measures discussed include further sanctions on Russia's shadow fleet of oil tankers and restrictions on its banks and major oil companies. Poland shot down drones in its airspace during a Russian airstrike on Ukraine. The Polish military calling it a, quote, act of aggression. It's the first time Poland has shot down military aircraft over its airspace since the start of Russia's war on Ukraine. Now, Russia saying just moments ago it is ready for consultation with Poland on the drones. Nepal's Prime Minister resigned on a second day of violent protests in the South Asian nation. The Press Trust of India says KP Sharma Oli stepped down after hundreds of demonstrators stormed his office. The unrest stemmed from a government ban on social media platforms, which has since been lifted. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Appreciate it. More from Vonnie in about 30 minutes' time. Up next on the programme, the Morning Calls Plus. We'll catch up with Dan Ives of Wedbush as Apple falls following its new iPhone unveiling. That conversation up next, live from New York City this morning. Good morning.
We definitely see more lingering inflation. When's the last time any one of us bought something in the last year and you said, wow, that was cheaper than a year ago? It has not happened. I do believe there's greater inflation, and companies are having a much more challenging time passing that along.
Just a fantastic exchange with Jim Zelter, the president of Apollo Global Management, a little bit earlier this morning. Catch that full exchange out on Bloomberg.com. And if you are a terminal subscriber, it will be on the terminal a little bit later this morning. Let's get to some of the price action as we count you down to the economic data. 14 minutes away for PPI. Equity futures positive by a third of 1%, up a third also on the Nasdaq 100. That's the price action. Let's get you some morning calls. First up, TD Cowen upgrading Nike to buy, citing market share gains and better management execution. Next up, Bank of America upgrading Oracle to buy, saying it's clearly capturing more AI infrastructure share. That stock is absolutely surging. And finally, Evercore raising its price target on Apple to $260, saying its new design could help reinvigorate its user base. Sticking with Apple, its shares falling after its latest product lineup failed to impress investors. Joining us now, Bloomberg's senior tech editor, Dana Wollman. Dana, welcome back to the program. You gave us the preview. Let's have the review. Is this going to invigorate the user base?
I think I'm going to be the voice of the consumer here, and also just speaking for what I know about consumer behavior. But I do think that this will be a compelling lineup for consumers heading into the holiday season. Apple really did an end-to-end refresh across its lineup, not just its phones, but also its smartwatches, and kept prices largely in line with last year's models. And I think none of this is lost on the average consumer. I think consumers these days are savvy enough to know that these are not just iterative chip upgrades or processor upgrades. They can tell when the phone looks different or when the watch looks different. And the fact that the prices are the same as last year, I think, will give a lot of people permission to go ahead and maybe take the plunge on the upgrade that they had perhaps been shying away from or holding off on.
You know what the pushback is from investors, Dana? It's not what it looks like, it's what you can do with it. And why we didn't hear enough yesterday on AI and new features and the future. Were you disappointed by that?
I wasn't expecting anything new on AI. Apple does typically sort of bifurcate its updates on software and hardware into distinct events. June is the developers conference, and the fall is typically all about the hardware. And it would have been really unusual of Apple to unveil a surprise new feature that it hadn't already been testing publicly in public betas for months now. Now that said, we do expect Apple to reveal more in the coming months, perhaps early next year, about its AI strategy and its AI rollout. But we were not expecting any surprise new features that had not previously been announced. The one that we were on the lookout for and that we did get was live language translation in the new AirPods Pro earbuds. But that was it in terms of expected AI features.
Dana, appreciate the update. Thanks for being here. Dana Woman there of Bloomberg. The stock in the pre-market down by something like 0.7% so far this morning. Let's get the bullish view on things. Dan Ives of Wedbush, 270 price target, outperform rating on shares of Apple. Dan joins us now for more. Dan, good morning.
Great to be here.
You've sat here so many times in September alongside us and talked about the upgrade super cycle. It hasn't happened. Is it about to happen with this, and why?
No, I mean, this, and those super cycles we've talked about, I mean, they definitely were disappointing, right? I mean, the reality, I think this is one where street expectations going in are, I think, pretty soft relative to next year. So when you think about on a scale 1-10, this is probably going to be an 8.5. Look, you do have over 300 million that haven't upgraded their iPhone. Is there going to be a huge catalyst here? I think a lot of it's just pent-up demand, especially in China. But the reality is, the elephant in the room, it's AI. And I think that's, when you talk about what's going to truly drive the stock, that's it. And we've talked about it. That right now is front and center.
Before we get there, and we'll find out more, I'm assuming, later this year at the WWDC, there is this signal from the fact that they didn't raise prices on the phone significantly, except for the highest end phone. Does this suggest that they're going to take it more on margin, especially given how much their costs are increasing pretty much across the board?
Yeah, I mean, some small price increase book. I think also the reality, that's why Cook, played nice in the sandbox with Trump, right? Because it's very important in terms of India and China, make sure they do have some exemptions when it comes to the tariffs. But look, the reality is they cannot raise prices significantly at this point, because the last thing you want is churn, other competitive issues. You have a phone that's definitely an improvement, but nothing that's jaw-dropping. And it all leads, the whole reason you own Apple, it's the install base. I mean, it's all about when they monetize the 1.5 billion iPhones for AI.
Can I just jump in? The install base. For a long time, you've seen that as a source of potential growth. Isn't it about time to start seeing it as a source of potential risk? That you've got this massive install base that hasn't upgraded for a long, long time. Don't we have to start questioning whether they ever will? And whether the real risk here is they might actually go and buy a different phone from someone else?
Look, we've talked about that. That's why we've been so, I think, strong in our view. Like, the clock struck midnight in terms of them needing to now goes back to AI, because when you talk about monetization and what keeps people in the ecosystem and what really is the golden goose for monetization, it comes down to AI. And the reality is every Apple event the last few years, I feel like Michael J. Fox Back to the Future, and that's been a big part of the problem relative to the rest of tech when it comes to embracing AI.
The install base is sick of waiting. That is sort of a worry that a lot of people have. And Samsung right now and Google are out there trying to troll everybody who's been waiting for something new and saying, ha, 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 look, ours fold. There's a question about, especially if they're getting a heads up or if they're getting a head start on the AI development, of whether the install base starts to leave. Aren't we starting to see signs of that? Doesn't that worry you?
Look, I think it is it's probably the stickiest install base out there, right? In terms of just when you think about Apple and customers that really don't leave. I think the worry is really around the monetization. And that's why we've said, Perplexity was really more to see what happened with Google. Once DOJ, once they had that victory, now I think they walked down the aisle from some sort of major partnership from a Gemini perspective. But I think this is a critical time, next 6 to 9 months for Apple, to make sure you have the AI strategy, you don't lose customers, you have an upgrade cycle that, right now in New York City, cab drivers bearish on Apple. So I think that sets up pretty positive relative there. But it comes down to AI innovation. There's a better chance of me playing Ryder Cup Bethpage than that happening inside of Apple. It has to come externally.
Dan, you mentioned Tim Cook playing nice in the sandbox with Donald Trump. Should he go on the state visit next week when Trump's bringing a bunch of tech executives like Jensen Huang?
I think you get on that plane because, I mean, you know it so well. It's like he obviously got called out in terms of Middle East. To the right, you have really the new trusted advisor wearing the black leather jacket, Jensen. I mean, Cook needs to make sure he's not on the outside looking in. And that's why that, what we saw last week in D.C. was also an important moment, too.
When you say that he's playing nice in the sandbox, when Lisa was asking about pricing of iPhones, he's constrained, do you think, by the White House and audience at one, or do you think he's constrained by where the consumers are right now and has to meet them where they are?
Yeah, I think it's a combo, but I think the reality, too, is that raising prices definitely is not the right thing to do from a consumer perspective. But when it comes to tariffs, that's also where, they're essentially doing a dance around, right? When it comes to India and China, tariff exemptions, obviously significantly investing in the U.S., but like we've talked about, it's a fairy tale that they'll ever make iPhone Pros in the U.S. Again, it goes back to if you like $3,000 iPhones, we should make them in New Jersey. So I just think that that's going to continue to be something that's in Asia, despite obviously a lot of the investments from an AI perspective in the U.S.
You're a bullish guy. Let's just finish on a really big name this morning, Oracle. $225 billion plus of market cap could be added to this company later on this morning. We're higher by 32% in the pre-market. What do you make of this move?
I mean, it's a drop the mic from Safra and Ellison, right? Because the reality is that it shows this AI revolution, as much of the haters and the skeptic, you look at...
Points to me.
No, I'm saying, dude, you're a big supporter. But I'm saying but Lisa, I think the reality is that many that are skeptical of maybe some of the growth, you look at these numbers, that ARR number, that's a drop the mic. And I think what that shows, the rest of tech, the rest of AI, that's what we continue to say. It's 10:15 and the AI party was 9 p.m. and that party goes to 4 a.m.
It's an outfit worthy of the stock move. It's good to see you. Thanks, Dan.
Great to see you.
Appreciate it, sir. You've got the distance to play Beth Page.
You never know. It's more of a short game. I don't have Ferro's long distance.
I wish I had that kind of distance.
Yeah, exactly.
Like McElroy 350 kind of stuff.
Exactly. Beth Page Black. That tests the distance.
I'm very pro-America. That's going to be like the few days that I'm going to be very pro-Europe on this program.
I know.
Oh.
I'd expect
you're going to have to let it go.
Of course.
Just give me some space.
But again, the difference is Europe doesn't have a guy named Scotty.
True, but we've got a guy named Rory.
And I love
a pretty
Rory.
deep bench as well.
Oh, and Rory's on a hot streak.
Okay, we'll talk more about this another time when we're not on live TV. Dan, thank you, sir. Appreciate it. Thanks. Coming up in just a moment, some economic data for you. PPI just around the corner. We'll catch up with Seth Carpenter of Morgan Stanley. A lot to break down for this point and the data point we get tomorrow morning.
Yeah, and we keep talking about at what point do we care about inflation once again. PPI, how hot does it have to come in and how much has to get translated to the consumer?
Got tickets for that?
I will have to.
Okay, all right, we'll talk.
Golf you're looking for someone to talk
with
you because it's not going to be us.
I mean, going to a Ryder Cup with Ferro would be a peak moment for me.
We'll make it happen.
Okay.
All right. The first of two inflation prints coming right up. PPI just around the corner, 20 seconds away. CPI tomorrow morning, 24 hours and about 15 seconds away. Equity futures on the S&P 500 positive here by a third of 1%. Up on the Nasdaq by a third of 1% also. In the bond market, these are the scores. 2-year, 10-year and 30-year bond yields a little bit lower at the front end, and the 10-year this morning. We're down about a basis point. The 2-year, 3.55. With your economic data, let's cross over to Mike McKee for more. Good morning, Mike.
Good morning, John. We were expecting a little bit of a decline in inflation, and that's what we got. Producer prices headline number on a month-over-month basis down 0.1%, which puts the year-over-year number at 2.6%. It was 3.3% in July. Core down 0.1% as well, so that moves us to 2.8% from 3.7%. And core ex trade is up 0.3%. That's half of what it was last month on a month-over-month basis, and puts us at 2.8% for the year. So that was as it was the last month. So at this point, it looks like some of the special factors that hit last month, and we'll look into this, didn't quite hit. Most of this was a decline. The August decrease, they say, was a decline in final demand services, down 0.2%. Final demand services was up significantly last month. Final demand goods did rise 0.1%, maybe a little bit less than people anticipated because of tariffs, but we'll have to dig into all of that in just a second.
Yeah, Mike, take your time. I'll run through the price action just briefly. Pretty obvious move off the back of a downside surprise on PPI. bit into the front end of the curve. Yields down by 3 basis points on a 2-year, 353. Push that through foreign exchange, a weaker dollar, as you might expect. Elsewhere, if you're looking at the equity market, a lift on the S&P 500 this morning by about 0.5% on the S&P. So session highs here. Likewise on the Russell 2000, a bounce here, higher also by 0.5. We often say this off the back of a data point here in America, that the first move isn't always the right move, and we'll see if this sticks as we go through the details. But the initial take is obviously going to be this allows the Federal Reserve to focus a little bit more on the weakness in the labour market and consider more rate cuts.
Yeah, the takeaway from markets is a 25 basis point rate cut is baked in. That's not the question. The question is how much is there an argument for a 50 basis point rate cut? Right now, there's 27 basis points of cuts getting priced in for next week. That, to me, is the key question. If this was going to be the barrier to hold them back from going big, well, it doesn't seem to be that much of a barrier. We'll wait to see what we get from CPI, but the first read seems to be that is not on the table.
And Mike McKee, details matter. What do you see on a second look?
Well, we see some declines in the things that went up a lot. Food prices were down just a touch this month because last month we saw a rise in fruits and vegetables of 38.9%. 38.9%, but in August they were down by 15.1%. So there's some good news there. Final demand for energy is basically unchanged, down 0.4% as electric power went down by 5.9%. So we're seeing some, that is natural gas, went down by 5.9%. So we are seeing some backing off of some of the things that went up during the month of July that were kind of unusual. The one thing I'm looking for here is consumer, the portfolio management issue. We were up 5.8% in July, 2% this month. So it's still inflation coming from portfolio management, but not as much as it was the month before.
Mike McKee, thank you, sir. Stay close. We'll come back to you in about 5 minutes' time. Just got a provocative message from a Bloomberg Terminal subscriber. 75 is the new 50. Joking, of course, but this will be a conversation in the coming week.
Joking, but not. I mean, essentially, at this point, 50 seems less of a reach when you start talking about the revisions and then not necessarily seeing inflationary pressure. Early days, let's wait till we get CPI, because the connection between producer prices and what consumers are paying don't always correlate to the same kind of degree that people expect.
Joining us around the table, Seth Carpenter of Morgan Stanley. Seth, good morning. It's good to see you.
Great to be here. Thank you.
I want to give you some time before we get into this data point to flesh out how you view the world right now, because I've been following your research, and certainly you and the team consider what took place on April 2nd and the months after that, not as an event, but as a process. And we've got to wait to let this play out in the coming months. Just flesh that out for us, how you're thinking about the world with regards to tariffs and the pass-through to end inflation.
Yeah, no, I think that's a key question. And I do get the sense, talking to lots of investors around the world, that people feel like we've seen tariffs, we've seen sort of how high they could go, we've seen a retracement, we get it. Now let's move on and look at what's next. And not sure we can quite move that quickly. Evidence we have from 2018 to 2019, evidence we have now this round, is that it takes 3-4 months before you really start to see the effect of the tariffs show through to consumer prices. The last 2 CPI prints, in fact, we were able to get evidence that in at least the core consumer goods components where we expect to see it, you are starting to see an initial pickup. It's not crazy. It's not the inflation that we saw a few years ago, but it's moving up for sure. I think the tricky part here is going to be the tariffs were much broader than what we saw in 2018. So trade diversion is going to be harder. On the other hand, there's a lot more negotiation back and forth. So how many industries are going to be gaming, absorb it for now, pass it on later? And I think that uncertainty is critical. I think we still have a lot of additional inflation from tariffs in front of us. And then what we can't forget as well is that tariffs hurt economic growth as well. In 2018, the evidence was 6, 7, 8, 9 months of a lag. We're just coming up on that in the fourth quarter and then into next year. Take the imports from China. 2/3 of what we import from China are either capital goods or intermediate goods that go into manufacturing in the U.S. So the tariffs are a tax on domestic CapEx and a tax on domestic manufacturing. The tax provision helped on the CapEx side of things to some degree. Tariffs are going in the opposite direction. Where's the net? How are things going to work out? I think these are the reasons why no one should feel like they have the whole picture already clear in their head.
Yeah, well, what you just described sounds a lot like stagflation, which no one should feel too happy about. It's always kind of the disaster, at least stagflation light, as some people have been describing it as. Do you disagree with Fed Chair Jay Powell, who said that any kind of inflationary pressure from tariffs will be a one-time price adjustment? And that is the reason why this central bank seems to be placing a greater emphasis on the slowdown that you're talking about, or, as we saw yesterday, some of the revisions in just the labor market lack of momentum that we've seen.
Well, I think as a baseline forecast, and we have to make our baseline forecast, the answer to that is, yeah, the most likely outcome is that tariffs will lead to a one-time increase in the price level, which means that the inflationary effect, the percentage change in prices, will be temporary. I think that's a really great place to start a forecast. That's where our forecast is. That's not, though, the only game that the Fed has to play. They also have to ask, well, what if we are wrong about our forecast? What if things turn out differently than our baseline? And in particular, the last time we saw tariffs, and it was temporary, we had the biggest problem for the Fed was too low inflation, not too high inflation. Here we are over 4 years into inflation being above the Fed's target for a long time. Businesses are kind of getting used to inflation being high. Consumers might be getting used to inflation being high. They might be getting sick of it, but they also might put less effort into thinking, oh my God, do I have to go look somewhere else for an additional lower price? Because now everything's just more expensive. So I think there's a risk that the inflationary impulse is longer this time, gets more embedded. And let's not forget, in the services component of things, we have now labor restriction going on because of immigration. We talked about the revisions to the labor market. Job creation was less than people thought. Job creation has come down a great deal. The unemployment rate, 4.3%. I'm old enough to remember when 4.3% was actually pretty good. And it's about unchanged. It's only up a little bit from a year ago. What that to me says is that the labor supply side of things is also come down a lot. And so then the question becomes, how do the services industry, especially the ones who might find themselves constrained for labor, how does that show through in prices?
So that brings us to the data that we get today, which shows that inflation really isn't as big of a concern as some people expected when it comes to producer prices. We'll see what CPI has to say. Some people are calling for the Fed to cut in a more significant way next week, maybe even 50 basis points. Do you think that if they were to do so, or even 75 basis points, let's cater to that Bloomberg subscriber, do you think that that would actually ignite the risk of inflation over the medium term, or do you think that that would be appropriate?
So I think the risk is that it would be premature to cut 75 basis points for sure, and even 50 basis points. I don't know, from my judgment, that it balances the risk between slow growth and inflation. Now, newsflash, I am not the chair of the Fed, so my opinion is much less important.
Yes, I hear that you could be in the running.
So the way I think about it is they've got a dual mandate. Full employment, maximum sustainable employment, i.e., how close is the unemployment rate to what they perceive to be full employment, which they've told us is 4.2%, and stable prices, which they've defined as 2% inflation. Inflation's above target, inflation's rising. It's not skyrocketing, but it's going up. Tomorrow's CPI is going to be really important for the consumer goods side of things. So where is that balance of risks? I think that's really the question. What Chair Powell told us at Jackson Hole was he changed his mind a bit and said, you know what? Now we're going to lean more on the risk of employment getting weaker and accept a little bit more risk on inflation going higher. At the prior FOMC press conference, though, he kind of had said, let's look at the unemployment rate. You know, you could imagine payrolls coming down a lot. As long as the unemployment rate is stable, that's what full employment, maximum sustainable employment is really about. So there has been a little bit of a change in that risk adjustment. There's no black and white. He's clearly wrong. He's clearly right. This is a very, very difficult situation for the Fed. Their two variables that they have mandates for are kind of going in opposite directions. That is the most difficult situation for a central banker.
Well, he went full Waller basically at Jackson Hole. But to John's point all morning, if they had this information in terms of actually where the economy was, the labor market was, do you think they should have been cutting? Would they have been cutting sooner?
I mean, I think there's clearly the argument that they might have been cutting sooner given where Powell is now, given his remarks at Jackson Hole. Given his remarks, though, at the July press conference that the unemployment rate, which is saying how is labor demand doing relative to labor supply, it's much less obvious that they're anywhere near as far behind the curve as you would infer just from a read on the non-farm payrolls print. So this is an extraordinarily difficult, nuanced, tricky situation. It is the time where it's both great to be an economist because we get to go into the details, and it's terrible to be an economist because nobody wants to hear it. Well, actually, the details here matter a lot.
Didn't we endorse you for a seat on the Federal Reserve 2 years ago? I think we did that on this programme before. That's not new. That doesn't feel new.
It's so serious. We can do it again.
Mike McKee's still with us. Mike, you've got more, I know. What have you got?
Well, I've been looking at some of the categories here, and as I mentioned, vegetables were a big decliner, but we also saw wholesaling of machinery down 5.2%, and I know Seth was just talking about that. Air travel, though, up 1%. One of those categories that does feed in to the CPI and to the PCE numbers. Also, we're seeing some changes in as I mentioned, portfolio management down a little bit compared to what it was, up just 2% compared to 5.8%. In general, what we're seeing is durable goods rising some, though. Electronic equipment up 5.1%. So there are some tariff effects, and we'll keep looking for that throughout the day. And I'm sure Seth and his staff will be as well.
No doubt. Mike, thank you, sir. Michael McKee there breaking down the PPI data. If you are just joining us, welcome to the programme. Downside surprise on PPI about 12 minutes ago, unleashing a lift in the equity market. Moving bonds too, yields down at the front end as we start to talk more about this conversation that will take place this time next week at the Federal Reserve. And I think it does open the door just a little bit more to a conversation about 25 versus 50 at next week's meeting.
Well, it certainly is in terms of the market pricing, but I keep thinking about what Seth Carpenter said, which is no one wants to hear, well, if you look at this, you take a look at this. But honestly, that's actually what I'm looking right now at in terms of oil prices going down, some vegetable prices going down. But if you buy a new phone, say, although not an Apple phone, because evidently the prices didn't go up too much, but certain electronics, the prices are going up pretty significantly. It's such a motley and confusing picture that to draw conclusions is a fool's errand.
Everyone wants to have an opinion. Just think you've got to stay super open-minded. And if I've got one opinion about the situation, I'm kind of with Seth. I've said this for a while. Don't view what's taken place this year as a one-off event. View it as the start of a process. And I think that allows you to stay open-minded about what's about to happen over the next several months. I don't know what will happen, but you have to view it as a process and not a one-off event.
And this is what a lot of corporate executives are doing right now. They're saying, let's wait. Let's not be first movers when it comes to jacking up prices by 10%. We'll wait, but slowly over the next 1 month, 2 months, 3 months, as the inventories have to be replenished, then we will raise prices. And that's when you're going to see it trickle out in that process. So on the flip side, yes, but oil prices are lower.
Seth, it's good to see you.
Great to be here.
Thanks for dropping by. Appreciate it. We like you where you are at Morgan Stanley. Ted picked us too. Seth Carpenter there of Morgan Stanley. Ted, I know you're watching around this time, so good morning. Equity futures on the S&P up by 0.5%. Let's get you an update on stories worldwide with your Bloomberg brief. Here's Vonnie Quinn. Hey, Vonnie.
Hey, John. Thank you. Well, just recapping the data, U.S. wholesale inflation declining in August for the first time in 4 months. The headline producer price index falling 0.1% from a month earlier. It did rise 2.6% from the year before. Tomorrow we'll get consumer price data. Economists expect core CPI to rise as tariffs impact prices. The Supreme Court has fast-tracked a challenge to President Donald Trump's tariffs. The court agreed to hear cases brought by businesses hurt by the levies. That hearing scheduled for the first week of November. The tariffs remain in place for now, but a decision striking them down could force the U.S. to refund tens of billions of dollars. Crypto firm Gemini has increased the potential size of its IPO to $433.3 million, pricing shares at $24 to $26 apiece. At the top of the elevated IPO range, Gemini would have a market value of $3.1 billion. The firm was founded in 2014 by Cameron and Tyler Winklevoss. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Appreciate it. Coming up on the programme, we'll catch up with Lisa Hornby of Schroders as we break down the latest inflation data. Plus, we'll touch base with Yahira to get your morning movers as Chewy falls in a pre-market by more than 8%. From New York, you're watching Bloomberg TV.
I believe the Fed should have a single mandate, which is price stability. The biggest, most punishing tax on the American people, our citizens, is inflation. And inflation's caused by too much money chasing too few goods. So I believe we need fewer mandates, and I think we need that monetary policy focused on price stability.
So the good news this morning for the congressman from Arkansas is that inflation came in below expectations, a downside surprise on PPI, a rally in equities and in bonds. Equity futures up this morning by about 0.5% on the S&P 500, on the Nasdaq 100 and on the Russell 2000. With about 40 minutes to go until the opening bout, let's get you some morning movers. Let's cross over to Yahara Anand for more. Hey, Yahara.
Hi, John. Oracle blew it out of the water when it comes to its growth projections, stunning Wall Street and helping to lift other AI infrastructure plays. That is because its booked revenue jumped 359% compared to a year ago, jumping to $455 billion in the latest quarter, thanks to massive cloud deals with the likes of OpenAI and NVIDIA, which is why you are seeing those shares rallying 3.25%. Oracle also said that its cloud infrastructure unit will rake in $18 billion this year, and that is expected to grow to $144 billion by the end of this decade. And that is why you're seeing CoreWeave shares up more than 10% because of that strength. Next up, we have regional lender Fifth Third Bancorp. Shares are down nearly 2% after the bank said it uncovered allegedly fraudulent activity by one of its commercial borrowers, forcing it to write off up to $200 million. And sources tell us here at Bloomberg that JP Morgan and Barclays are also exposed, but because those are bigger banks, they are not getting the same level of scrutiny as this regional lender. And we end on Chewy. You mentioned this one. Shares are down nearly 10% now after its Q2 results failed to meet high hopes. Its profit fell in the second quarter, and it did post a sales beat, but it was only slight. So it was just not enough to keep up with the hype after shares had run up 20% from an August low through yesterday, and a number of analysts had raised their price targets. John?
Down almost 10%. Yahara, thank you. Appreciate it. Three of the stock movers to watch going into the opening bell. Heading into the opening bell, this is the trading diary at 10 a.m. Eastern Time. The Senate Banking Panel votes on Fed nominee Stephen Myron. Later on, this takes on additional importance. 11:30 Eastern Time, the President receives his intelligence briefing. Then at 7 p.m. Eastern Time, the President hosts a dinner in the Rose Garden, or the Rose Garden Club now, is that what it's called?
Rose Garden Club.
The Rose Garden
It's
Club.
basically like
Okay.
Mar-a-Lago.
But not in Washington. I get it. All right. Thursday CPI data plus another round of jobless claims and an ECB rate decision. And on Friday, UMich consumer sentiment data. Let's stick with the data. This morning's PPI inflation print coming in colder than expected ahead of CPI tomorrow. Lisa Hornby of Schroders joins us now for more. Lisa, good morning.
Hi.
Does that set us up for 50 next week?
I think the market's definitely going to make a push to try and price that in. Just looking at WIRP a couple seconds ago, I think pricing looks like about 12% probability of 50 basis point hike at this point, and I think the market's probably waiting on CPI tomorrow to see if it confirms what PPI already did. Our base case is still 25, but I can see that going either way.
So if CPI comes in lighter tomorrow, you think the 50 basis point of a rate cut could actually increasingly get priced in? It might be even appropriate.
Yes, I think it will be. I think more will be priced. I don't think the Fed really set us up for 50, so I think we might see some governors, surreptitiously try to guide the market a bit if they want to if they're trying to go that route. But ultimately, I think the market pressures the Fed versus the other way around. So if we see the market making an aggressive move push towards 50, I think the Fed might end up delivering that.
As a bond investor, does this make you wary of going into longer-term treasuries, or does it actually encourage that investment, given the slowing that we've seen in some of the labor metrics?
So it's interesting. The curve's a tough one right now. We were biased towards steepeners, but we're more neutral at this point. And the reason for that is, coming into this last few months, we were concerned about the same thing as the rest of the market, right? Fiscal instability, the Fed being politicized, the economy looks relatively resilient, but now we've seen this labor market deterioration in a more meaningful way, which means the Fed's concerns were warranted. So I actually think the long end could do okay for a bit, in part because the steepener has been so consensus. Everybody's hated the long bond for so long. Probably nobody owns any long bonds, and that's why we've seen a 25 basis point rally in the last week and a half. And some of the other reasons is the administration really wants lower rates, not just in the front end. They want lower rates in the long end, right? They want the housing market to be stimulated. They're talking about what emergency measures they can do to stimulate the market. Who says that they can't do something a little bit more creative and actually more explicitly target the long end in some way? I mean, buybacks of the 20-year, things like that.
Are you expecting that from this administration?
I wouldn't be shocked. I mean, they've thrown us for a lot of loops, right? And this is clearly a priority for them, is how do they unlock the housing market? They could do something maybe on the agency side, perhaps, but another way is reduce the amount of long issuance in favor of the front end. And I don't think that would be that controversial.
So you're looking for flatteners?
Near term. I think near term we could see a little bit of flattening. And, there's this slowing momentum. People will start to become concerned about a U.S. recession. I don't think we're headed there, but I think that concern will build, especially if we continue to see weakening labor markets. And so that should be supportive of the long
What do you think yields can come down to, 10s and 30s? What kind of numbers are you thinking about?
So we've been long duration, but we've been reducing the magnitude of it.
Okay.
So I think there's still further to go. It's hard to pinpoint a number. Could we get another 25 basis points? Sure. Our view of the economy is that we're in a bit of a soft patch, but we might be coming through it in the next few months. So we won't see that maybe till the springtime. But, we had a lot of policy uncertainty with regards to tariffs that probably put companies off from hiring. But look at the amount of CapEx that's being done right now. I saw a stat that the last 3 quarters, something like 35-40% of GDP is actually investment spending. So, that has a big multiplier effect down the road. It's not immediate, but I do think that that's really important. Plus, we have the tailwinds of fiscal policy that are still influencing the market. Plus, we have supportive monetary policy. It's hard to see where we get a real downturn.
Near-term slowdown risk, medium-term you see reacceleration risk?
Yes. Yeah.
Okay. All right. The trade at the moment in fixed income, as you know, is to position for a steepener. I'm not sure how many positions there are out there for a flattener in the near term, at least.
Which maybe is one reason why it's supported, as we were just sort of hearing. What I find fascinating is we started the show with Peter Tchir talking about Operation Twist, with the Fed potentially using its balance sheet at the same time that the Treasury works around issuance. And we finished the show with Lisa Hornby of Schroders talking about similar types of creativity to create a flatter yield curve, not a steeper yield curve.
Yields are lower. That's the good news this morning. 10s are down by 2 basis points, threatening to break 4%. Lisa, appreciate your time, as always. Thoughtful, as always. Lisa Hornby of Schroders, as we count you down to CPI tomorrow morning, following a downside surprise on PPI this morning. Coming up tomorrow, Steve Chevron of Federated, KBW CEO Tom Michaud, Tiffany Wilding of PIMCO, and David Kelly of JP Morgan Asset Management. Record highs coming into Wednesday. More record highs in store from New York City. Thank you for choosing Bloomberg TV.